Good morning, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another one of these Monday market updates. Got a great video for you today and a market update. Obviously, wrapping up kind of a horrible 2022 for most investors. Stocks in the S&P 500 are now down about 20% for the year. Looks like that's about where they're going to close at. But there are still ways you can make money, and that's what I want to talk about this week, along with our Monday market update. Going to be looking at the Bowtie Index. We just launched this in July, and it is beating the market over the past 6 months as well as the past 3 months. The past 3 months, the S&P 500 has rebounded a little bit. It's up 1.3%, so not a great return for the market, but it is up over the last 3 months. But the Bowtie Nation Index is up 7.4%. So I want to talk about how we're doing that, why the index is beating the market, how you can invest in that way. It's not a tradable index yet. It's not something you can invest directly in, but I want to show you how we're picking stocks there so you can do that with your own portfolio. I also want to talk about some of the requests that a lot of you have had out there for additions into the index. A lot of stocks that you think should be in the index that aren't yet. I want to go through those, and then stick around though, because then we'll have our Monday market update, all the stocks I'm watching this week, what to watch for 2023. This will act as kind of our forward-looking 2023 stock market video. So be sure to stick around for that. And then we're going to do questions and answer, my favorite part of these live streams. Just getting to know all you out there in the Bowtie Nation and answering your questions. So I want to get started because, again, like I said, this is, the Bowtie Nation Index, or the Bowtie Index, ticker BOWT. Again, that is not a tradable. It's not an ETF yet. It's not a fund. It's an index, a trade, or an official index we launched with Stock Card as well as Index One, to follow really the best of breed stocks in the 500 largest companies in the United States. Now, for legal reasons, I cannot say the stock market index that you all know we're based off of, the stock market index that I am following off of this, because we're not paying licensing fees to Standard & Poor's, to S&P. But we can talk about how the index is doing against the SPY. That is the Spider S&P 500 ETF that covers, or that tracks, those 500 largest companies in the United States. So we can compare the index against that, the SPY, and you can see here, just over the past 3 months, the BOWT, the Bowtie Index, is up 7.4%, the SPY up 1.3%. So returns of 5 times the market right there. We really moved away from them in November there and have kept that lead, have kept that margin. We did back-tested results. You can, if you go here to Stock Card and you go to the Idea Center, go to Indexes, you'll find this Bowtie Index, and you can see everything we're talking about here. But we can go to over the last year. So we can see over the last year, the Bowtie Index would have been down 17.5%. That is still beating the market by about 2%, a little over 2% there. And then over the last 5 years, or well, here it says 6 years, back-tested 6 years, the Bowtie Index would have been up 178% versus 70%. But I don't like to focus on the back-tested results because, who knows what would have been in the index at that point. I like to look at what we've actually done, and you can see that right here. What we've actually done over the last 3 months is really, really interesting, how we've been able to beat the 500 largest stocks in the stock market, just over the last quarter. So I want to go through first, kind of how we've been doing that. I've also linked in the video description below some of the first videos that we've covered on the Bowtie Index. Check those out because those are going to really go in depth in how we're setting up this index, how we're finding those best of breed stocks, really. And it's going to start with these quantitative factors. Okay, we've got four quantitative factors, or 5 quantitative factors. And this is really just kind of that first check to make sure that we're only investing in the best of the best. We're targeting the top 10% best stocks in those 500 largest companies in that stock market index, right? So we're finding the just 50 out of the 500 stocks that are really the best of the best in their industry and in their sectors. Okay, so we're starting off with these quantitative factors. You see here on the left, this starts off with 3-year sales growth higher than the sector median. Okay, So what we're doing here is within each sector, we're going to invest in a group of stocks in each sector to make sure we have a sector neutral basis, right? We're going to invest in exactly the same percentages across the sectors as that broad stock market index. That really takes the sector performance out of this index. No matter which sector outperforms in any given year, we're going to be there. We're going to have stocks in that sector. What it gives us an opportunity to do, since we are in every sector and we're really a sector neutral index, then that gives us the chance to pick the best stocks in each sector and really outperform, on that stock picking ability there. So, but back to these quantitative factors, we're really looking for here these any stock, any company that can grow its sales, its revenue over the last 3 years at a faster pace than the sector median. So companies growing their revenue, growing their sales faster than their peers across that sector. Okay, so some kind of an advantage that is allowing them to grow sales faster than the other companies in their sector. Then I'm also looking for a 1-year sales growth that's higher than the company's own 3-year sales growth. Okay, that's the second one here. And really what we're looking for here is just that momentum, that increasing momentum in sales, where not only has the company beaten sales on a 3-year average, beaten the competitors in its sector, but it's also beating itself, right? It's also growing sales, faster in the last year than it has in the last 3 years. Next one here, the operating margin, 3-year operating margin higher than the sector median. Again, of course, this is comparing, trying to find those companies that really have some kind of a competitive advantage in efficiency, that they're able to turn those profits into, or those revenue, those sales into profits at a better pace than the sector average, okay, than competitors in their sector. So that 3-year operating margin higher than the sector median. And again, click through the videos I have in the description. Those are going to go through much more detail and explain these out a lot better than what we can do real quickly here. I'm also looking for a one year operating margin higher than the 3-year operating margin of the company itself. Again, we're not only looking for companies that are beating the sector average, beating their competitors in revenue growth and in operating margin, in that profitability, but we're also looking for companies that are growing increasing that momentum, getting more efficient in their profitability. So the operating margin over the last year is better than their own 3-year average. And then finally, we're looking at the PEG ratio, right? The price to earnings to growth ratio, just trying to get some kind of a valuation metric in that. Now from there, and I'm going to show you some examples of how we're applying these factors into the Bowtie Index, how it is beating the market by 5x here in the third quarter. We're also taking those stocks and then going into those qualitative factors you see here as well. Those product innovations, the market positioning, which companies really dominate their industry and dominate their sector, to have a competitive advantage over their peers, as well as that strength in governance, the strength in management. How is management doing against others in its industry? And of course, if you scroll down here on this page, you can find all the videos that we've done on the index. I've also linked those in the description. And what I want to look at in this video is this share your ideas section, right? You can scroll down and look at what stocks are actually in the Bowtie Index, as well as their percentages. You can see when we bought them. We bought all these in July 3rd is when we started the index. You can find the price returns on those as well. But what I want to look at is this survey here that we've been asking since July. What other stocks would you add to the Bowtie Index? And I've been compiling those here. You see in a spreadsheet, getting your suggestions on the index. And I want to talk about these because these were some really great suggestions, some great ideas from all you out there in the Bowtie Nation. So I really wanted to talk about some of these stocks that you want added to the stock market, to the index, why I have or haven't added them, and what ones I might add in the future. I've linked there in the chat to the to Stock Card. Go ahead and you can go through there, find that stock market, that Bowtie Index. If you do use Stock Card, if you do sign up for it, make sure you use the promo code BowtieNation. That's all one word in lowercase. You get a special discount beyond the free trial on that. But let's look at some of these stocks that you wanted added or you suggested we add to the Bowtie Index. Now, one thing you do have to understand that I am building this off of the 500 largest companies based in the United States. Okay, so that broad stock market index, the SPY, if you want to compare it against something, and for that reason, some of these suggestions can't be added, right? Because they're not in that index. Now, what this allows us to do, though, is starting from that smaller list of just 500 stocks really makes it easier to complete the research necessary and really follow each stock in the index. Okay, I can't sit here and research and go through all 5,000 stocks tradable on the U.S. exchanges to create and follow the index and to keep that index up to date. So we're starting with the 500 largest stocks in the United States. Really gives us a good base of large, financially strong companies from which we can really dig down into each one of those, into the best of breed in each sector, and really give us that outperformance that we've seen over the last 3 months. That 7.4% return over the last 3 months versus the S&P or the SPY, the Spider SPY index of up just 1.3%. So for that reason, we've got some suggestions here from Chad, from others for things like, so Nathan wanted to add the Every Holdings, ticker EVRI. We had, Chad Taylor here, Bowtie Ambassador, one of the longest members or longest citizens of the Bowtie Nation there. Love Chad there. Chad wanted us to add SoFi, ASO, Academy Sports, ticker ASO there. Love SoFi. It's one of the big stocks in my own portfolio, but these aren't part of the S&P 500, right? The largest 500 stocks, the index there. So those can't be added, but I did want to talk about some of these other ones. Robert suggested we add UNH. Okay. So that is United Health. This is actually a stock that we've talked about on the channel before. I highlighted UNH just a couple of months ago on an acquisition that it's recently pushed through that I think does give the company a very strong competitive advantage. Okay, the video that we did about 2 months ago, actually, the United Healthcare announced its acquisition for Change Healthcare, which is a healthcare information services, right? Healthcare information services for insurers, for other healthcare providers. And the government initially fought this acquisition. It took it to court to stop this acquisition of Change Healthcare by United Health, and because just saying that it would give United Health an unfair advantage, it would give them a monopoly advantage in the insurance space and in healthcare. And I actually agree with them. I actually agreed with the government on this point. But the fact that the acquisition was ultimately held up in court, it was allowed to go through. The court said that United Healthcare could in fact acquire Change Healthcare, that it wouldn't create some kind of a monopoly advantage. That is going to be a huge advantage for United Health, because what we saw and what we talked about in that video is that Change Healthcare, as an information service provider to a lot of these competitors for United Health, they had a lot of their business practice information, a lot of the decision-making information or the decision-making data that went into these competitors' business practices is now going directly to United Healthcare. So United Healthcare now has all this information that was previously used by its competitors to make their business decisions, and is going to have a big leg up in being able to make its own decisions there. So, this is actually one I've covered. It wasn't the one that we ended up going with in healthcare. Again, because we're taking a sector neutral basis, we are investing in the same percentages of each sector in that broad stock market index. So those 500 largest companies, we're investing in the same percentages of stocks as that index. So we're taking a sector neutral basis, basically. So if you look at what sector percentages are in that broad stock market index, say you've got tech stocks are about 20% of those 500 companies, right? So that would be about 100 companies in that broad 500 stock market index. 100 companies are in the tech industry, right? Or the tech sector. So what we're doing, since we're sticking with that same percentage, but only investing in 50 stocks, only the 50 best of breed stocks in the market, then we're only doing 20% of that 500, right? So, or 20% of the 50. So So that's only going to be about 4 stocks, right? So we are only investing in a limited number of stocks each sector, and that really really narrows down our list of what we can invest in each sector. And I'm going to show you this data here, what we're actually investing in, and how I'm tracking this. So here you see every stock in the in the SPY, every stock in that 500 stock market index. You see here the the symbol, the name, the industry, the sector, and then you're going to see here these criteria, the criteria that we just talked about. That those first 5 criteria, that is, the sales growth over the last 3 years, the sales growth over the last year, operating margins, the operating margins for the sector, or the sector average for the revenue growth, and then the sector median for the sector average for the for the operating margin, right? And this is really how we're doing that first pass, that initial pass over these companies to see which ones fulfill those quantitative factors, right? Which ones show us some kind of a competitive advantage that is allowing these companies to actually, beat their competitors on sales growth, to increase that sales growth momentum over the last year, to beat competitors on that operating margin, that profitability, as well as beat their own momentum in profitability as well. So if you see here, we can search for a UNH, and that's going to bring us down here. So if we look at UNH, then it only met the criteria for 2 out of the 5 of these, right? So that is probably a big reason why it didn't go into the index there in July. Now, again, I may end up adding this stock to the index anyway, because I think it's going forward, it's going to have that great competitive advantage in the insurers. I think insurance is going to do very well over this next year as the rest of the stock market kind of weakens and kind of wobbles a little bit. But you can see here. So for that first criteria, UNH, United Healthcare's revenue of 8%. Revenue over the last 3 years, the average was only 8%. That is less than the sector average of 10%, right? So it didn't meet that first criteria. Second criteria, the revenue over the last year, 11.5%. It did beat its own 3-year average, right? So just over the last year, it has started to pick up the pace in that revenue. So it has done very well over the last year, and that satisfied that second criteria. But again, here, if we look at the operating margin over the last 3 years for United Health, only been about 7.4%, and that is well under the 17% average for the sector. Okay, so it is underperforming the sector on that profitability basis. It is improving. So just over the last year, it did about 7.6% operating margin. That profitability measure that did beat its 3-year average. So it is getting better. If you look at United Health, it is improving on its revenue growth. It is improving on its profitability. It's just not telling me that it's that best of breed within its sector, right? It is still lagging the sector in some of these. And then if you just look at the price to earnings for United Health, price to earnings to growth, it is fairly expensive still on that measure. So that is why that we didn't add United Health there. But again, it is definitely one to watch on kind of that competitive advantage that it's going to get from the acquisition that we saw. We also had we had 2 people ask for Dollar General. Okay, so we saw Stephen and, I guess Stephen here had 2 requests in there for Dollar General, ticker DG, to be included. We've talked about Dollar General. It's another strong company. I highlighted this dollar stores as well as Dollar General in a May video as really some of the safest stocks in the market, right? Some of the stocks that typically do well when the stock market crashes, and shares are up this year. If we look at the 1-year chart here for Dollar General, it is up. It is not up marginally, so up from $221, up about $20, up about 10% actually for Dollar General this year, which against a stock market crash of 20%, 10% outperformance is really strong. And we talked about why that was in that May video. Basically, people are going to, when people start worrying about their jobs, worrying about their income, and worrying about a recession, they're going to go where their money goes further. And that's hard to beat there at those dollar stores and that Dollar General. So we did talk about that in May. We didn't add it to the add it to the bow tie index though, because it's not necessarily one of the best in consumer staples, right? So we can go here to find Dollar General. Here we are, Dollar General, and we can look at the ones we did add instead. So here's Dollar General. Actually, Dollar Tree is down there right under it as well. And we can look here, and so Dollar General only satisfied that first criteria. Okay, so it's 3-year revenue growth. So the revenue growth over the last 3 years is averaged 10%. Now that is over the sector average. Sector average for the consumer staples has only been about 4.6%. So Dollar General was growing its sales faster over the last 3 years than the sector. So it satisfied that first one, but the sales are slowing down. Here we see over the last year, Dollar General has only produced a 1.4% sales growth. So that is really problematic. That sales growth is slowing down. It's something that we would want to watch. And then when you go to these the other profitability measures, right? Operating margin, the 3-year operating margin is well below the sector average, right? Sector average of 15.8% profitability for the consumer staples companies there. For Dollar General, it's only about 9.5, 9.6, right? So over the last 3 years, about 9.5% operating margin for Dollar General. Over the last year, it's been about 9.4. So it's actually fallen a little bit. So getting a little less profitable as that inflation eats away at their profitability, at their margins there at Dollar General. So this is one of those stocks where it is going to probably still continue to protect your money as the stock market wobbles a little bit, but it's just not the best of breed in that. We can look at what stocks we actually did invest in instead. So I've got the consumer staples video there linked in the description if you want to look at which stocks in the consumer staples we invested in instead there. Also want to talk about PXD. So we had Nestor here. Nestor said we should invest in PXD. That's Pioneer Natural Resources, ticker PXD. Very close to adding this one. He talks about in the business since 1997. PXD, they're one of the best explorers and developers. They're in those natural gas liquids as well, which is a great industry to be in right now for energy. So I wanted to look at this PXD, show you why maybe that wasn't included in the index. So here we are, Pioneer Natural Resources, ticker PXD, and we can go over here. And this one hit 4 out of the 5 of those criteria. So this one was very close. We actually ended up ultimately adding ConocoPhillips, ticker COP, as that energy name in the index. I really wanted an energy company with a little bit more diversified business, right? The energy explorers, so the drillers, have done really well over the last year. I'm afraid that's getting a little bit valuation. Valuation is a little high on some of those, and of course we see that in the price to earnings to growth ratio for Pioneer Natural Resources. But so we went with COP, the ConocoPhillips, because it's got that more diversified business, a little bit closer to the end user, to the customer with those gas stations and that kind of thing. But PXD really did do very well on these other criteria, right? If you look here, revenue growth 24% over the last 3 years on average. That is almost double. That is more than double the sector, that is more than quadruple the sector average of 5.5%. It has actually increased that 154% over the last year. So increasing revenue growth, doing very well. Operating margin of 17% over the last 3 years. It has increased that to 36% over the last year. So definitely be looking at Pioneer Natural Resources, ticker PXD. That is one that I would probably consider adding to the index if maybe we invested in one more energy stock besides COP. We also had a suggestion for Tesla. Okay, so both from Anthony and Chad. Chad Taylor suggested buying shares of Tesla, ticker TSLA. Now, Tesla is obviously a strong contender on that sales growth, a rising operating margin as well. So not only is Tesla growing its sales by upwards of 50% a year, which is an amazing pace for sales growth, especially for a very large company like this, it is also getting more profitable, right? A rising operating margin. At the time in July, when we were first selecting stocks for this index, I was worried about kind of the valuation of shares of Tesla still. It is down 48% since then, so I think it was the right call at that moment. I was also worried about Elon Musk's April offer to buy Twitter. So here we were in July talking about adding stocks to the Bowtie Index or making that initial pass. And Elon in April had already made his offer to buy Twitter. It looked very strong. I actually did another video on why he was going to be forced to buy Twitter and how that would work out. And so, buying Tesla, it was just not the right time. Now, of course, Tesla is about to wrap up its worst year ever for this stock. Shares of Tesla, we can zoom out here to the 1-year chart and see that it's fallen all the way from $355 on that split adjusted basis all the way to $123 this year. So almost fallen to a third of its value, and almost fallen to 65% or so there over the last year. Now, what worries me a little bit still with Tesla is not the valuation anymore. I mean, it is trading for a very low price to sales. If we look here, price to sales for Tesla is now down to about 5.6, which is less than half of where it traded over the last couple of years. Shares of Tesla have actually traded for 25, 30 times on a price to sales basis, and here it is down under 6 times price to sales. So not necessarily worried too much about the valuation on Tesla anymore, but there is some things that we do want to watch before we would add it to the index. One is what are the sales going to be like going forward in China? Actually, we can cover this in a little bit on some of the news that we're watching this week, but Tesla did say it would be shutting down and then reducing the operations at its Shanghai factory, the Gigafactory there in China. That actually accounts for about 40% of the company's total productions, right? So 40% of the company's total production is now going to be reduced there in China. And this is a part of two factors, really. One is that November and December and even October production at that factory was so much higher. They actually did some incentives to get people to put in orders. They ramped up production here over the last 3 months at that Gigafactory in Shanghai. So now bringing that production back a little bit is just really bringing it back a little bit closer to normal. But it's also a matter of trying to fight those COVID that COVID surge there in China. Hoping that some of these competitors like NIO won't eat into its sales and production targets there in China. So it's really something that we have to watch. Something else I want to watch here in Tesla, really that just watching the fourth quarter production and the first quarter outlook for this for U.S. production. What we've seen here over the last really 6-7 months with Elon Musk is he's really becoming much more of a polarizing figure. The fear is that whether you like him or not, the fear for an investor is whether Elon Musk as a polarizing figure is now acting to kind of an albatross around the neck of Tesla investors and Tesla stock, right? If a large percentage of the population out there do not like Elon Musk, if they do not want to be associated with him in any way, then does that mean that they might not consider buying a Tesla? So that's really what we want to look at for shares of Tesla. And I think it's why a big part of the reason why shares are down 65%. It's not necessarily that people think that he's going to be selling much more of his shares of Tesla. It's not that people are really worried about Tesla as a company. They're worried about that association between Elon Musk and Tesla and how that kind of works into the reputation for Tesla. Now, of course, there are still a lot of people buying this stock. Kathy Wood over there at ARK Invest is loading up on shares of Tesla. And if you look, they still have a very high price target for shares of Tesla. What you got to understand about these price targets you get from Tesla, and we see here, average analyst estimate is still at $250 a share over the next year for Tesla. A lot of these analysts, what you won't need to understand about these long-term price targets for Tesla is that a lot of these are based on not only that electric vehicle market and that continued domination of that market. So you kind of have to question that, whether some of these legacy automakers like Ford, like GM, like Toyota that are coming out with their own EV EV models, whether they're going to be able to eat into that domination, eat into that market share for EV. But even more than that, if you look at the ARK Invest price target for Tesla, which at one point was as high as $4,000, I think that's still right around $1,000 per share on the split adjusted basis. But if you look at that, half of it is based on the idea that Tesla is going to have some kind of a self-driving robo taxi. Okay. And of course, this is something that we've been promised for years, not only from Tesla, but from the entire industry, the car industry, those self-driving cars, as well as the robo-taxis. And they just haven't come around, right? So it is something that has been pushed back year after year. But about half of the price target, or the valuation for ARK Invest on shares of Tesla is based on the fact that, Tesla can come out with one, a completely self-driving car, and two, can monetize that within a robo-taxi. So basically, you're going to have, self-driving Teslas driving around, picking people up just like Uber, except without a driver, right? And in just kind of the profits and the margins and being able to dominate that market as it has been dominating the electric vehicle market. So there is a lot of, anytime you see these huge price targets for Tesla, the $4,000 at one point out of ARK Invest, you really have to look into what that's based on and whether that's actually going to happen. So now, I do want to, like I said, I put that link there in the chat if you want to check out the Bowtie Index. Check out some of the videos linked in the description below. I'm going to show you how we're actually beating the market by 5x this quarter, as well as give you a chance to request your own stocks be put in the index. Now I want to turn it over to our weekly stock market update. Talk about some of the stocks we're watching this week. And kind of give you an update to the 2023 outlook, what we're looking at here. First, I want to actually look at generic holdings, or Generac, I guess, ticker GNRC. This is the worst performing stock in the S&P 500, right? Down 75% this year. And it's really kind of amazing for a dominant leader in those standby power generators, okay, right? So Generac is really controls about 70% of that home standby generator market. Okay, so obviously we know all about them here in Florida because of those hurricanes and the frequent power outages because of hurricanes here in Florida. But all over the country, anytime you lose power, you can get one of these standby generators to give yourself power for a few days or even a week. And this stock has always been a very stable, very consistent performer because of those that mature business industry and just the dominance in its market. 70% of that home generator market in Generac. What has happened over this last year, though, and why these shares have fallen 75%. We can zoom out here to the last year. You can see here, fallen 75% over the last year because it's really transitioning its business model into solar power, right? It's hitting the shares on two fronts. First, it means increased spending really to acquire companies in the space and launch its own products. So a big part of the strategy for Generac getting into that solar power industry now is acquiring companies that already have solar power products. So that's increased spending there, increased spending on research and development to create its own products. So that's one thing. The second, right, stocks in the renewables energy companies have just tumbled this year as well on those higher interest rates, right? Along with those growth stocks in renewable energy, solar power have tumbled this year, and that's really contributed a lot to this 75% loss in the company. Now, what I will say is shares are now trading for a decade low of just 1.3 times sales, right? So if you look at sales growth for solar power companies, renewable energy, it is obviously a growth industry. So if Generac can tap into that, can really get any kind of a market leadership like it's done in that home generator market, these shares could take off, right? If it is in fact more of a growth company than it has been in the past in that mature home generator market. If it's now a growth company, growing sales at 10-20% plus a year, then it could go up to 3-5 times on a price to sales basis, right? It is now trading for 1.3 times. So I would be watching this stock if the market does rebound, if these growth stocks come back, if the solar power market comes back, if the renewable energies space comes back in the market, and we get a little bit better valuations on these stocks, then this is one that could that could come back very quickly. Also want to look at some of the sectors that what the sectors have done this year, as well as what they did over the last week, and really how to invest in that. Here in the Sector Spider, the sector tracker here in sectorspider.com, great resource there. Of course, all you out there in the nation know we love this tool. It's a free tool there. So you go to year to date, and you can really see the communication services sector, right? So this communication services, the XLC here, down 39% this year. By far, really the worst performing sector against that 20% drop in the market. So almost twice the loss in the market just in this communication services sector. Now, in this sector, you got to understand there are quite a few industries in there. The telecom industry, so AT&T, Verizon, all those telecom and wireless companies, they've held up pretty well, right? They've held up a lot better than the other industries in this communication services sector. You've got other industries here, and you can click through here to see which stocks and which industries are in there. So of course here you see the T-Mobile is up 20% this year. AT&T only down 1.5%, and you're going to see a lot of these. Verizon's down 26%, but those telecom names have held up fairly well against the market plunge of 20% this year. What you do see also though, if you change this change percentage to see the hardest hit ones, is those other industries, gaming stocks. So what we're looking at here is gaming, social media, and streaming. Okay, within the communication services sector, those three industries: gaming, streaming stocks, streaming networks, as well as social media, have been hit hard this year, okay, on different reasons. Gaming stocks facing a steep drop in users versus those locked down pandemic days, right? So that's a factor that's not going to be turning around anytime soon. We had a historic highs in gaming and users gaming over the past couple of years, and that is slowing down now. So that's really hitting these gaming stocks like Activision, like Take-Two, things like that. The streaming stocks, you got stocks like Paramount, you've got stocks like Warner Brothers Discovery, you got Netflix down 51%, those other stocks down 50, 60%, Walt Disney down 43% this year. Those streaming stocks really dealing with an increased cost to produce that content, right? Along with an advertising revenue drop because of the recession, right? So really two fronts here, these streaming stocks, that competition, we've got Netflix, we've got Disney, as well as HBO Max, and probably too many streaming services, right? But we've got those three, and the amount of content put out by these studios is just amazing, especially Netflix. Netflix is putting out a ton of content, every week, every month it seems, and just the competition here is making that so expensive to do. So we're really seeing that the cost to create all that content, all those shows, is really eating into the bottom line, eating into profitability for these streaming stocks. That is not something that's going to turn around even after this recession, right? The advertising revenue hit that these streaming companies are facing, very similar to the social media stocks. Obviously, as we head into a recession, we start seeing consumer spending slow and slow down, then companies are spending less on advertising, right? So that means less ad revenue for these streaming networks, for Warner Brothers, for Netflix, for Walt Disney. So that's hitting the bottom line as well. Now, what I'm thinking here is that while those content costs aren't going down anytime soon, that competition is only going to be increasing and going to be hitting the bottom line for those streaming stocks. That ad revenue should pick up, late next year, late 2023. As we dig ourselves out of this recession, as we start seeing economic growth, companies are going to be starting to spend more on their advertising, and that's really going to lift these some of these stocks. Not necessarily streaming stocks all the way. They will do well as we start seeing that ad revenue increase, but they're still going to have to deal with those that increased cost to produce all that content. What I'm looking at here is the social media stocks. You also see here in this communication services sector, you see shares of Meta Platforms, the old Facebook, down 65% over the last year. You see Alphabet, so Google, right, down 38% over the last year. So these social media stocks really getting hit hard on that ad revenue, as well as the Apple privacy changes, right? The Apple privacy changes on the Apple in the Apple Store, really hit these companies in the about April of this year. That is something that they're starting to work their way around those. But the drop in ad revenue is really the big story here for these social media stocks. And of course, like we said, that is something that is very fixable here in the next year. As the economy starts growing again, then you're going to see that ad revenue pick up. And I think that's going to be one of the first things to turn here. You're going to start seeing these social media stocks like Facebook, like Google, like some of these other social media sites, even Pinterest and some of those others, you're going to start seeing them report higher ad revenue and improving margins, and you're really going to see those stocks take off. So that is one that I would watch as well. Bank stocks, also another group I'm watching here in 2023. All you out there in the nation know I was watching bank stocks here in 2022. The financial sector is down 13%, so outperforming the market this year, doing well, against the broader stock market this year. Insurance companies and banks have held up this year. But what I'm really watching for in 2023 is kind of even more outperformance, right? In fact, Wells Fargo analyst Mike Mayo, great banking analyst, actually believes that banks could be heading into an era of profitability that is stronger than any time since the 80s. Okay, so 40 years, 40 years of profitability there. One of the best periods coming up for banks, and a lot of that is just based on those higher interest rates, right? Over the last decade, interest rates have been zero, and that's really hard for a bank. Obviously, really hard for a bank to make any money if it can't make that much on its long-term loans that it lends out to businesses as well as consumers, home loans and business loans. Now that interest rates are heading up, then those banks are going to be able to make more on those loans. So that's really going to drive that profitability over the next 2 or 3 years. And what we've seen here over the last year, the reason why these bank stocks and the financials are down 13%, even in the face of that increased profitability, that increased revenue, is just because of those recession fears, right? People are worried that the recession is going to come along. Those loan defaults for business customers, for mortgages, are going to increase, as the housing market slows down. And that's really weighed on the industry this year. What we've been watching, though, is how much bank stocks and how much this industry is putting away in its cash accounts, right? The bank stocks have been putting away tens of billions of dollars in a cash reserves account called loan loss provisions on its balance sheet. It really has a huge stockpile of cash just in case the recession does get bad, and it needs to pull on that cash to prop up its earnings. So I think that's what you're going to see here in 2023. You're going to see it start applying some of that cash. You're going to start seeing it applying some of that cash back into its earnings. You're going to start seeing earnings outperformance here by the bank stocks in 2023. And eventually, you're going to start seeing that profitability come through for the bank stocks. And that's a really one that I'd watch. Last sector here, or last group here that I would look at, the FANG stocks, right? These were once the darlings of the stock market. The FANG stocks, FAANG, that would be, Facebook, which is now Meta. You've got, which is down 65% this year. You've got Netflix down next, 51% down this year. Amazon's down 49%. Alphabet, which is Google, is down 38%. And then even Apple, the best performing of those FANG stocks so far this year, still down 26%. So still underperforming the market. Apple, even as the best stock in that group of five. And what I would be watching here is, I've started buying shares of Amazon and Meta. I think, again, the problem here with the social media sites like Google, like Facebook, is that ad revenue that is something that is going to be fixed here over the next year. Obviously, Meta and Facebook have longer term issues with spending on that metaverse, but I think Mark Zuckerberg's going to have the last laugh on this. I know a lot of you out there don't like him. A lot of you out there think he's kind of an ass clown. I think he's kind of an ass clown myself. But he has been proven to be able to live by his mantra of move fast and break things, right? One of the best quotes I like as far as a business owner: move fast, break things, and that's what he's doing. He's moving fast. He's spending a lot of money in this metaverse kind of idea. And, whether you believe him or not, I think we are definitely moving to that kind of immersive metaverse kind of interactive internet kind of experience, right? And, I think Facebook is just positioning early. They're early to the party, and they're going to be dominating that just like they dominate social media. So that is why I'm also buying shares of Meta. I think it's going to do very well here over the next year as that ad revenue starts to pick up yet again, and do that. Amazon as well. I think Amazon now at very attractive valuations. But you've got to kind of watch those. I think these are strong tech and media companies. This Facebook, the FANG stocks really as a whole. Facebook, you've got Alphabet, Amazon, Netflix. I would worry more about Netflix. I wouldn't necessarily start buying yet, just because of that content competition there in streaming stocks. But all of these, the rest of these FANG stocks, Facebook, Alphabet, Amazon, and Apple, all coming to very attractive valuations. I want to back it up and talk about kind of what I'm seeing for the sectors over the past week. As we wrap up 2023, what to look for. We did see 6 of the 11 stock sectors close higher last week. The energy stock rebound there on higher oil prices. Oil is doing very well, up about three of the last week, the third consecutive week so far, and likely up this week as well on that that increased use for heating here in the United States and really globally. Last week, utilities, consumer staples, and healthcare really drawing investors in for that protection. The broader market was down 0.2% last week. So, all the volatility, the huge Thursday sell-off, stock market was only down 0.2%, so that wasn't too bad. But we did see the safety sectors like utilities, consumer staples, and healthcare outperform. Financials also outperformed last week on just those higher interest rates, right? Interest rates for the 10-year Treasury bond went up from 3.5% to 3.75%, so a huge move in interest rates over the past couple of weeks, really lifting that profitability that we're talking about for the banks. Automakers, if we look at the individual industries and stocks from last week, automakers were really the big losers. GM and Ford were down both 6% last week. Tesla, talking about Tesla, was down 18% last week. It is down also in the pre-market and as the market opens up today. So we're going to talk about that. Consumer spending does appear to be slowing. So what we're looking at here for these automakers, especially some of the higher price cars like Tesla, is that consumers are going to be pulling back on their spending, and especially those bigger ticket purchases like cars. So while that near-term bounce, can't be ruled out in shares of maybe something like Tesla, which is down more than 20% just in the last week. The oversold levels, it's not, it could be a rough couple of months for those. Now I want to talk about some of the other stuff I'm seeing in the market. We can look here, seeing some of the stocks moving here as we open up the week. China stocks, talked about this the last couple of weeks. China is now moving off of its zero COVID restrictions. So while the rest of the world really opened up, after 2020, after 2021, China has remained locked down. Limited travel allowed in China, testing, quarantines for whole cities, even sometimes. There in China, it is now just over the past month really announced an easing of those restrictions after 3 years. So really, the market is really watching these Chinese stocks and what they can do here in the next year as China opens up. What we've seen also over the last year, as the rest of the world, as central banks really raise interest rates, try to slow down their economies, especially here in the United States, the Fed increasing interest rates by about 4.5% just over the last year, trying to slow down the economy. China's central bank and Chinese government has actually been stimulating the economy, right? Since they've remained in lockdown there for the better part of 3 years, they are lowering interest rates. They are having stimulus programs to really boost the economy. And what we're seeing here now over the past couple of weeks is these stocks have really taken off on the idea that, if China is going to be coming out of that lockdown, then we could see increased economy or a growing economy there, and the stocks could benefit. Also looking at some of the airlines this morning, Southwest Airlines, ticker LUV, sliding 4% in the pre-market, and we can look at what that's doing also. Southwest announced that it is only going to be flying about a third of its scheduled flights here, even today and tomorrow, even Tuesday and Wednesday. It is slashing a lot of those flights, trying to get people back to their destinations after canceling something like thousands of flights over the weekend because of that storm. And This is affecting all the airlines, United, American, Delta as well. All down because of those cancellations. Tesla, we're going to look at Tesla as well. Also down today, 5% in the pre-market. Let's look at where it's trading right now. We can update this. So Tesla down 6.5% so far today. Again, on the news that it is reducing the production there in its Shanghai Gigafactory. There's a reduced rate in January, and then following an end of December shutdown. So it shut down completely here in December, and is going to be running at a reduced rate in January. And again, that Gigafactory in Shanghai for Tesla is 40% of the company's entire total production, right? So if you even slow that down to, even 20%, if you slow that factory down 20%, down to 20% of its normal production, that is an 8% total production drop in shares of, in Tesla. So really having to deal with that, what that means for the shares overall. And we can see here down more than 5% here so far today. We can also see, some of these others, Peloton coming out with refurbished bikes, discount up to $500. So that's could be helping the stock today. NIO shares of Chinese electric car makers down as well. A lot of this is talking about as China comes out of that zero COVID policy, we could be seeing millions of infections there rising in China. In fact, a lot of Chinese we see here in the Wall Street Journal, the Chinese rushing to the exits as Beijing ends that zero COVID policy. Right. So what a lot of Chinese people are looking at here, two things here. One, they're getting the hell out of the country while they can. Over the last 3 years, there's been very limited travel in and outside of China. So people are getting out while they can, ahead of that surge in possible infections. And this could mean very good things for some of the travel agencies, though. That's one thing. One of the stocks you want to watch, I think, is Trip, Trip.com, a Chinese travel company there. Trip.com group, ticker TCOM. It's up 3% so far today. We look at what it's done here over the last 6 months. So here in November, you really see where China started talking about that relaxation of the COVID policies, right? So relaxation of the lockdowns there in China, trading for $25 a share there. It is now up to $35. So up about 40% there just in the last 2 months. But I think as we start seeing the numbers for China travel come through, I think Trip could go even higher. We can zoom out here to the last 5 years. It is down over the last 5 years, down from $45. I would watch Trip.com. I would watch that up to maybe even $40 here over the next couple of months, just as we start seeing some of those numbers come through for China travel. Then we do see, if you read through this article, I think they talk about something like 3 times the Trip.com has seen bookings more than tripled from the day before. So 3 times the number of bookings on their website just here in the recent over the recent weeks as China has loosened those restrictions. So definitely one to look at. I think you can also look at over the next year healthcare stocks, especially the biotechs. Another article here in the Wall Street Journal talking about a healthcare deal-making surge in 2023. It's something we were looking for in 2022, but just because of that recession, a lot of these deals were called off. But just over the past couple of weeks, we have seen a lot of increased buying and acquisitions here in the biotech space. We're looking at a $200 billion patent cliff over the last year and over the year to come. So a lot of these pharmaceutical companies, you've got Johnson & Johnson, you've got Gilead, you've got Merck, a lot of those really big pharmaceutical companies, the drug makers, really seeing a lot of their drugs come off patent protection. Right. So they're looking to acquire a lot more, a lot of these younger and a lot of these smaller biotech companies that maybe have these new drugs that are being approved. And that's why we're seeing an increase in acquisitions for these companies, and why as 2023 looks a little bit healthier for the economy and for the markets, you might see that increase. So one fund you might want to look at here is the Alps Medical Breakthrough ETF. That's ticker SBIO. Now, what I'm looking at here is the small and mid cap biotech companies, right? So, there's two ways to invest here. You can look through individually all those biotech companies out there and see which ones have the best drugs that are being approved by the FDA or the ones going through trial. And really, if you're some kind of a pharmaceutical, you have some kind of a pharmaceutical background, drug background where about the FDA process. You can research into these drugs, these individual drugs seeking approval. Then that's a great way to do it. If you can actually find those individual biotech stocks. Most people can't do that. I can't do that. It is very difficult to sort through all of the research for each individual drug undergoing FDA testing and FDA trials, and really find those individual stocks. So what I like to do instead is really look at the funds here, the funds that are holding, dozens and even hundreds of these smaller biotech companies, right? These are the companies that are going to be bought out, that have those drugs that are going through trials and are going to be bought out by the larger drug makers here over the next couple of years in that M&A boom with healthcare. So what you want to do, you want to look at these ETFs, these exchange traded funds that hold those small and mid cap biotech names. Okay, you don't want to invest in the larger ones. Companies like Moderna, companies like maybe BioNTech, those might be a little bit too large to be acquired by some of these other companies. But definitely look at the small and mid cap ETF names. For this week, there's not a whole lot of news. There's not a whole lot of economic data or stocks reporting their earnings. I did want to cover one thing that I heard talked about by another YouTuber last week. He was saying that because of the limited volume. Okay, so as we get here into the holidays, a lot of the institutional traders, a lot of the institutional investors, a lot of the day traders kind of go on holiday, right? Until the new year. So you have very limited volume in the stock markets, over these last couple of weeks and over this week. And that's not likely to change this week as well. A lot of institutional traders not at their desks there in New York. And I heard another YouTuber talking about this last week and saying that this actually, that lower volume depressed those market changes, right? So we had that huge sell-off on Thursday. He was saying that if market trading was at normal, if market volume was at normal, then that would have been much higher. That would have been like 3 times higher. And that's just not true. So I wanted to clear that up here, talk about why that is and why we're seeing such volatility in the markets this week and last week, okay? Because that reduction in volume actually amplifies the changes in either direction, okay? And if you think about it this way. If you get some kind of news that drives stocks lower, right? And there's just not the number of investors out there trading stocks. There's not the institutional traders at their desks watching that news and trading stocks on that news. Then you're going to have the entire side of the market into sell mode. Okay, sell mode or buy mode if it's good news. But generally, if something negative comes across the news wire, then you've got everyone's selling, right? The market makers are still obligated to buy those shares. So if you ever look at the trading floor at the New York Stock Exchange, you see those big pillars that have the names of the companies across the tops, and you've got 1 or 2 guys standing at those pillars all the time. Those are market makers. Those are guys that are contractually obligated to buy shares of that company if anybody wants to sell, or to sell if anybody wants to buy, right? Those traders on the floor, they can buy and sell amongst each other, but they can also be guaranteed that they will get a price from the market maker, right? And that guarantee just makes sure that market stays open for any stock they're traded on the New York Stock Exchange for those market makers. But the problem is that if everyone's selling, those market makers, they don't know if they're going to be able to offset that position, right? If everyone is selling, they're forced to buy those stocks, those shares that everyone is selling. Then they don't know if they can find a buyer to offset that position, right? So they're obligated to buy those shares. They're obligated to make a market in those stocks that they cover, but not at any certain price, right? So that's why you see these huge drops in prices. That market maker for Coca-Cola is saying, yeah, I got to buy those shares from you, but I'm gonna take a discount on those shares at such a large discount that even if I have to sit on those shares before I can find a buyer to offset that price, then I'm still gonna make money, right? So that's why you see that market amplified. That bid ask spread is gonna widen whenever you have lower volume, okay? And so that's why we see in these weeks of very low volume, because because everyone is still out on vacation rather than following stocks and rather than filling their books with stocks. Then that's why you see this volatility increase. That's why you see volatility increase. That's why you see the ups and the downs even more, like we saw last Thursday, where I believe the market was down 3.5% at one point, because of those amplifications. And again, that is because the lower volume this over the last couple of weeks. So I want to look at I want to turn this over to the question and answer. I'm going to go up here and look at your questions. If I don't see your question, make sure you ask it again with a question sign, so I know that it is a question. I'm going to scroll through here, see what we've got. Again, thank you all of you for joining us for these Monday market updates. Love really reaching out to you live there out in the community and seeing where you're at. Billy Marion, see you there. Simplified brother. What's your thoughts on NOC and LMT? Okay, so Northrop Grumman, ticker NOC, LMT, Lockheed Martin, ticker LMT there. We can look at those stocks. What I will tell you is aerospace and defense doing very well this year, obviously. Very stable long-term contracts for those defense companies, as well as aerospace, right? So aerospace and defense, these companies like Northrop Grumman, Lockheed Martin, really getting two tailwinds this year. One was just those that increased defense spending, long-term contracts, things like that. And the rebound in air travel, right? Over the last couple of years, air travel obviously down because of the pandemic. As that rebounded, obviously people were going to buy more planes. The airlines were going to buy more planes, so that has helped the aerospace segment of that aerospace and defense. When Russia invaded Ukraine, obviously that was a big boost to to the defense companies as well. The U.S. obviously not actively involved in the war in Ukraine, but we are putting quite a bit of weapons into Ukraine. In fact, the U.S. just approved its $1.7 trillion funding budget for this next year, of which I think about $40 billion, something like that, was earmarked for Ukraine as far as weapons and assistance. So that is something that's going to, for as long as the war in Ukraine is raging on, that is something that's going to prop up these defense companies like LMT, like Northrop Grumman. And we can look at these. I want to look at LMT. We can look at that. Now, I might worry about valuations here on these companies, because as we said, when Russia did invade there in February, did invade Ukraine, all of these stocks just bounced higher. We had Lockheed Martin trading here for about $386 here in February, bounced up immediately to $450. So a big boost there. And then I think, here in October, as the U.S. started to talk about how much defense aid or how much weapons spending was going to be pushed into that annual budget for Ukraine, I think that's where you saw this other big boost here from about 389, from about 390 a share up to right now about 485 a share. So I would kind of worry about the valuation here. We can go to statistics here on Yahoo Finance and see that it is trading for 2 times on a price to sales basis. That is quite a bit higher than we see here in the past. Here over the past few years, we've seen Lockheed Martin trade for 1.6, 1.8 times price to value or price to sales. So it is quite a bit more expensive than what we've seen here in the past, about 10-20% more expensive than it has been in the past. I think it's a little expensive at this point. It is trading, it is putting paying a 2.5% dividend yield. I would like to see this come down a little bit. We are starting to see Russia kind of talk about how it wants to start talks over a closure of this. I don't think it's going to come to anything. I think this war is going to continue on through at least the next 5-6 months. But eventually, you do start seeing that come to an end, and I think that that really hits these shares here. So I would wait maybe for a pullback in shares of some of these defense companies, these Lockheed Martin, Northrop Grumman, things like that. Very good long-term outlook on there on defense spending, but a little pricey at this point right now. So I want to, what else we got here? Melanie, I see you there. Thank you. Thank you. Hey, Chad's here. Chad from Lifters Gym, bow tie ambassador there. Merry Christmas to everybody. Of course, got the bow tie frozen to my neck here. It is about 35 degrees here in Tampa, which I know is a lot warmer than where a lot of you all out there are, but it is cold as balls here for us in Florida. What else here? PK Lawn Care wants to know about NYCB. NYCB, one of the big stocks I hold in my own portfolio, has fallen quite a bit this year along with the rest of the banks. Within NYCB, you got two things here. Why it's falling so much more than the rest of the banks this year. One is because it is just paying out so much in dividends, right? Right now, this New York Community Bank Corp, ticker NYCB, is paying out 7.9% on a dividend yield, which is one of the highest you're going to find in banks. But of course, if it's paying out so much more of its earnings as dividends, it's not really holding much back for acquisitions, for growth, and that kind of thing. So you're typically going to see NYCB fall more than the rest of the market. It's very much more tied to the New England states and New York economy, which obviously if that's struggling a little bit, then you're going to see this stock fall. I do still own shares. I like this company for the long term. Most of it is just on that general macroeconomic backdrop for the banks. We are starting to see net interest margins really increase for the banks. And of course, that net interest margin is just the difference between what the banks are collecting on their long-term loans. So those mortgages, those long-term business loans, the difference between that and what they're paying out on deposits, right? So anyone that has a savings or a checking account know that banks are not paying anything on those deposits. So they're getting basically free money on those deposits when you put your money in the savings account and then loaning that money out to make yields of 5, 6, and even 7% here on mortgages, even more on business loans. So we're starting to see that net interest margin really pick up for these banks. I think shares of NYCB gain back everything they've lost this year. Over the next couple of years, and then you've still got that 7.9% dividend yield, while you wait. So I do own shares of New York Community Bank Corp. I like the smaller banks here. They are much more in that net interest margin kind of idea, right? They're not, they don't have that capital markets exposure like maybe Goldman Sachs, like maybe JP Morgan. They are much more a lending and commercial bank. So I do like NYCB. Obviously, they're going to be weak for as long as we're looking at a recession and worried about a recession. But they are, financials are going to be one of the first stocks to come back out of a recession, right? Those yield sensitive stocks, those interest rate sensitive stocks, like the financials, are going to be the first ones to come back when the economy starts growing again. Okay, DL. DL wants to know, there's a big question there. Warner Brothers did the cancellation of projects in the editing room versus streaming them. So what do you think happens to Lucid, SoFi, Lending Club, Lending Tree, AT&T, Warner Brothers? Does Tesla Semiconductor have a realistic chance of succeeding in the trucking industry? How will owners be able to change? A lot of questions here. So I'm going to try to answer a couple of these questions by DL. Tesla coming out with its semi truck. It is a new, completely new industry for Tesla. They've been trying to develop this semi for quite a while, but haven't had much success. I think it's really kind of a non-factor for Tesla at this point. Tesla really needs to develop its self-driving robotaxis business, as well as just retain that dominance and production numbers in electric vehicles, in passenger cars, right? Semi trucks are probably way down the list of priorities for Tesla, so I don't think it's really something that's really going to move the needle much for the company. Again, I think the first thing Tesla needs to do is work on its reputation problem, right? Right now, as Elon Musk becomes more of a polarizing figure, and again, I don't say this to try to trash Elon Musk or try to trash Tesla. I'm just saying that a lot of people out there don't like him. In the past, he's always been very much a controversial person, but he's never been really polarizing, right? You could hate him, but you could still love Tesla. Well, right now we're seeing, people hate him to the point where they don't want to be associated with him by driving a Tesla. So I do want to see Tesla kind of address this and really affirm or reaffirm its production numbers here for the next year, depending on what we see here in the first quarter and whether it can meet those production numbers. So I think that's the first thing Tesla needs to do. I think the second thing is really reassure the market that self-driving technology is coming, when it will come, and how that's going to affect those price targets for a self-driving robo-taxi kind of project. Because I think, again, if you look at the price targets for Tesla, those longer-term price targets by ARK Invest, by some of those other companies that have huge price targets for Tesla, half of it is in that self-driving robo-taxi business. So that is something that is very much dependent. Those price targets are very much dependent on that idea, and I want to see more news from Tesla out of that. Some of these other companies you're asking about: AT&T, Warner Brothers Discovery. So I do own shares of AT&T. I've owned them since the beginning of the year. They've done very well versus the market. They are down a little bit. I think AT&T is down about 1.6% so far this year. And we can look at shares there, but it's held up the dividend fairly well since that breakup, since that spinoff of its streaming services to Warner Brothers. So AT&T here, you see over the last year, it is down just marginally, about 1.6%. Still paying a 6% dividend yield. So again, I do own the shares here. I think AT&T after that spinoff is a much more focused company, right? They are getting back after years, decades of really just buying up whatever they could buy up. They bought Dish Network, right? They bought they bought AOL. They were trying to be pretty much everything content, and really took the eyes off the prize, right? They just weren't focusing on what they do best, which is telecom. So here, after that spinoff last December, they really refocused on the telecom sector. They're really trying to monetize that 5G spending they've done over the past few years, and I think they're really starting to see that. Okay, so we did see a 1.5% down on shares of AT&T this year, but they have paid the 6% dividend. So you are actually up in shares of Tesla or in shares of AT&T over the last year, and I think that goes even higher. Right. I think they start to take away some of those investor fears about the company here over the next year as they start making more money on the 5G and as the cash flows improve here. So again, I do like shares of AT&T here. I think it's one of the most stable stocks out there as far as that telecom and safety stocks there. Warner Brothers Discovery, last one here for DL. Talked about Warner Brothers Discovery here in those streaming stocks. What I'm watching, really worried about just the content costs for those streaming companies. It costs so much to put out all that content, all those shows every single month, every single quarter that. We're just seeing so much the bottom line, the profits eaten away at these streaming companies. You've seen it in Netflix. You've seen it in that 43% drop in shares of Disney this year. You've seen it in all of these streaming stocks. And Warner Brothers Discovery, it does have kind of the benefit in that Discovery Networks segment that is mostly documentaries, mostly that reality, quote unquote reality shows. So that's a little bit less costly to produce. So we can go here. I can actually go to Warner Brothers Discovery. So that Discovery Studios segment of that company is less costly to produce. So I think that helps the stock a little bit, but they just don't have much else, right? Warner Brothers, the whole DCEU fiasco that has nothing coming out, really isn't going to help them any. So it's just kind of a weak studio and really competing against some of these other mega studios like Disney, like Netflix, that are really pushing out that content. I'm not an investor in Warner Brothers Discovery at this time, and I'd be a little worried about them, here over the next year or so. What else do we have? Loading up myself. What are your thoughts on JEPI? So Joe G wants to know about JEPI and QYLD. Okay, so two very popular covered call funds. First, we've got the JEPI, the JEPI, JP Morgan Equity Premium Income ETF, ticker JEPI. here paying a 10.6% yield. So I think that's what a lot of people are attracted to for these stocks, this QYLD as well as the JEPI. But the thing you got to realize, folks, here is they are destroying shareholder wealth in terms of the price here. And I'm not just talking about the QYLD or the JEPI, but all these covered call ETFs. They are, the price is going down quite a bit. So these really have to be ones you hold on to and wait for a better price, wait for them to come up. They will, those dividend yields are attractive. They are fairly stable. I do like the JEPI over some of these others. If you're comparing the JEPI, so this JP Morgan Equity Premium Income ETF against the QYLD, against the NUSI, some of these others, I do like the JEPI better, just because it has outperformed so much better than some of these other ones. We can compare them here. Let's do the QYLD. We can do that. We'll look at the NUSI, which is the nationwide NASDAQ 100 covered call ETF. We'll put that one in here. We'll put the RYLD, I think is another one, RYLD, which is the Global X Russell 2000 covered call ETF. We can add that one. And then the XYLD, let's add that one as well. That is the, that's not a one. RYLD, XYLD, let's say covered call. Okay, XYLD, that should show up. XYLD. Okay, there we go. The Global X S&P covered call ETF. Let's add that one and see how these have all done. So here we see, we'll go full screen here for you. Okay, so here we can see the JP Morgan Equity Premium ETF, ticker JEPI, against these other covered call ETFs. QYLD here in in red, dark red here, purple maybe. The NUSI in purple, the RYLD in yellow, and then the XYLD in gold, I guess. You see here over the last, let's look at year to date for these. So here you see the JEPI down 12.7%, but actually outperforming the rest of these stocks, right? You can't see it here, there in the corner, but down at the very bottom, this the NUSI down 33%, the QYLD down 28% over the last year. So I need you to look at the charts on these stocks before you buy them. That 10% yield looks great. The 12% yield for the QYLD looks great, but then you really have to be committed to holding these stocks for years and longer to make sure to see if maybe you can get the price up a little bit. If we look at even longer term charts, so we got the 5-year chart here. Well, we don't have that for the JEPI, but we can look at the 2-year chart. Again, the JEPI is outperforming, and that's why, I do recommend, if you're going for some of these covered call ETFs, if you're going for that high dividend yield, then I would look at the JEPI instead of some of these others, because you see these others just over the last 2 years, the QYLD has lost 30% of its value. The NUSI has lost 32%. Even these other two, the RYLD and the XYLD, losing 14 and 17% of their value. Whereas, the JEPI has at least pretty well kept up its value, as well as producing that 10% dividend yield. So that is something to think about. If you're looking at these covered call ETFs, everyone says they're going to hold on to it forever. They're just never going to sell, and so they don't care about the price. But if you look at your stocks, folks, look at the stocks in your portfolio and how long you've actually owned them. Have you owned any stock more than a few years, right? So if that's the case, then you really do need to take a hard, answer this question. And, if you can't commit to owning those stocks for years and years and hoping that maybe the price comes back up in a market rebound, then there's other better ways to get your dividend yields. Chad says he likes GNRC. I think GNRC, Generac, it can be a very strong stock when solar rebounds, and when they can prove that they can transition into that. So, I do think, if you're if you're looking at a stock, the worst performing stock in the S&P 500 this year, GNRC, I talked about it earlier. I think that is definitely one to look at. What else? Ari says Amazon is going to return well over the coming months. Excited about AWS. Okay, so yeah, Amazon. We've talked about Amazon in the Facebook group. We have a private Facebook group there for Let's Talk Money. Talked about Amazon there, and there's really two things you want to do when you talk about whether a stock is cheap or not. Okay, so you can look at the valuation of the stock, and we can look at that here for Amazon. So we can look at, Amazon is now trading for just 1.7 times on a price to sales basis. Okay, that is, if you look at these other years here, trading for 2.4 times, trading for 2.3, 3.5 times, trading for as high as 3.8 times on a price to sales basis back in 2021. So now trading for, about half of that valuation. So it does appear, on that historical basis that shares of Amazon are lower, are very cheap, on that price to sales basis. The next thing you need to figure out though is, is that merited? Are the shares cheap for a reason, right? Is AWS, so the Amazon, the cloud services that the company is doing, is that losing market share to maybe to some of these other cloud providers like Microsoft especially? You really need to look at that. You need to look at the e-commerce segment and what the growth is like that versus Shopify versus Etsy. Is it losing market share to some of these other e-commerce sites? Now, if you can still say that, not only is Amazon attractive on that valuation basis, but it still has that kind of growth that is going to bring that valuation basis back to, something like something about like 2 or 2.5 times on a price to sales basis, then it is a good investment. And yes, I do like shares of Amazon. Again, I own shares. They've just started the drone deliveries in a few markets. Those are very exciting to see that and how well that does. So I think you can look at shares of Amazon as well. What else? Checking later. Stocks today. Just trying to read through some of the comments here. See if I can find any questions. Chad over there at Lifter's Gym does bring up an important idea of tax loss harvesting. This is going to be one of the last days you can do that. So again, understand whenever you sell a stock, then that sell doesn't get, recorded, doesn't get cleared for another, usually about 2 business days, right? So, you have to have all your stock sales cleared before the end of the year, before the 31st, or I think this year is before the 30th because of the weekend, to be able to tax loss harvest those. Okay, so this 27th, 28th, Tuesday and Wednesday, really one of the last days you can sell stocks to kind of offset your gains. Okay, so what we're talking about here is if you sold any stocks this year that had gains, and you're going to have to pay capital gains on those, or taxes on those capital gains, then what you can do is you can look through your portfolio, look at some of the losers, look at some of the money, some of the stocks where you're down a little bit on those. If you sell those now, before the end of the year, you take some of those losses to offset your gains in those other stocks that you sold, and you won't have to pay taxes on that amount. Okay. You can take up to $3,000 loss on your on your investments and take that off of your income for tax purposes. But you really need to measure out what stocks you sold this year, how much, where you're at as far as a capital gain or a loss, and then look through if you're at a capital gain, then look through what you can sell and offset those gains with your losses. Now, again, it doesn't make any sense if you sold stocks and have got more than a $3,000 loss, then to sell more, because you can only take that $3,000 maximum off loss off on your taxes. So be watching for that. Again, today and tomorrow, probably the last days you're going to be able to do that, to be able to clear before the end of the year. So you really need to do that today or tomorrow. Look in what you're doing as far as those tax loss harvesting. What else do we have here? What happens in China? Affect luxury discounts. Okay, so yeah, so Trend Board talking about what's happening in China is going to affect the luxury sector. Some of those, those LVMH, some of the stocks that we've talked about, Tapestry as well. some of those luxury stocks that have done very well over the last year because, the consumer spending on the, on the high side of income has held up very well versus some of the other consumer spending. Obviously what happens in China, I think initially we're starting to see a very strong increase in consumer spending and travel in China as those lockdown restrictions come off. What I am worried about is, as infections creep up as well as those COVID case levels increase and people start getting worried, and maybe some of that news hits some of these stocks, and so you got to kind of worry about that. But I think over the next year you're going to see very strong performance from the Chinese travel sector, from luxury stocks in general, as well as some of those Chinese stocks listed on the U.S. exchanges. What else? Looking through more of these, more of the news. If you've got a question, please ask it in the chat there, and use a question mark so I can see that it is a question. So Carrie wants to know about EPR, equity properties, I believe, right? EPR properties. So we can look here, one thing you have to understand about all REITs, all real estate investment trusts, they are down hard this year. So we can see here EPR properties down from about $48 to begin the year down to $38 now. So it's down about 25%. That is in line with most of the real estate sector this year. Real estate stocks down about 22% so far this year, really on that rise in rates. Okay, so obviously real estate, very much a highly leveraged sector. You don't pay all cash for real estate. You use those loans. So what investors are saying that as interest rates increase, then that slows down the buying and the price appreciation in these real estate stocks. So we can look at EPR properties. I believe this is I want to say this is a residential real estate. This says specialty real estate. If we look here, leading experiential net lease real estate trusts, select properties in real estate, focus on estate venues, create value by facilitating out-of-home leisure and recreation. So it's going to be resorts, right? So EPR properties, owning resort properties, other leisure properties, things like that. So you want to look at travel through the U.S. and those kind of experiences. I'm not. I guess we have seen very strong trends in travel through the U.S. as people, come off of the lockdowns over the last couple of years. They're still traveling. They're still staying in hotels. That's why we've seen hotels do very well. Rather than some of these specialized REITs, I would rather invest in maybe the hotel REITs, the hotel owners, things like that. I know this EPR properties does pay a very strong dividend yield, 8.8%. I'd be worried about the sustainability on that. And if you look here, in historical data, you can kind of follow that dividend, and what you want to worry about, or what you want to watch here, and make sure that you are watching this, is not only the dividend sustainability, but the growth here. So we can see, we do see that they decreased their dividend in 2020, because of COVID, down from 38 cents to 25 cents. They increased it just here over the last couple of years, over the last year, to 27 cents. So they are back to dividend growth. They had a pretty good history before that, 27.5 cents. It is a monthly payer. So if we go, so they are paying 27 cents a month. They're paying $3.30 a year on this. So what you want to do, you want to look at their cash flow and really make sure that they're able to cover that, that dividend with cash flow. That's one of the first things you need to look at in these high yield stocks, especially high yield REIT stocks, is look at their cash flow. And that's not earnings, because earnings are skewed by depreciation for these REIT stocks. But look at their cash flow per share. Make sure that it is well above that $3.30 per share. Because if it is lower than that $3.30 a share, then obviously that's going to affect dividend growth. It might even mean a dividend cut in the future. We don't really get any signals of that right now. So I think right now the dividend is probably sustainable and safe here. But you do have to worry about that kind of a dividend yield out of a real estate investment trust. What else here? We get JPI, SBLK. Excuse me. So Cajun Nathan wants to know about SBLK. I know it is a short-term bond fund, right? Nope, Starbolt Carriers. So again, the high yield stocks here. So this one's showing a 32% dividend yield. This is definitely anytime you see a yield over 10%, folks. Really over 8, 9, 10%, you need to start thinking about that dividend sustainability, the dividend history, and whether these companies are going to be able to keep that up. Okay. Now we have seen the share price fall this year, probably increasing that dividend yield a little bit. But we can go here to this historical data and see what it's been doing as far as dividends. Go to 5 years, go to dividends only. And we could see, it just started paying dividends here in 2019, 5 cents a share. It increased. It's got a fairly good history of increasing dividends all the way up to March of this year, but has since cut. So it is very much kind of an unsustainable or an unpredictable dividend, right? It is very much tied to that bulk carrier idea, what they're getting. Now, lately, we have seen very good rates in the bulk carriers, in those carriers, especially for oil. A lot of Russia obviously being cut off from the rest of the world as far as oil exports. Then it's having to resort to kind of a shadow fleet of oil carriers. So that is helping to propel some of the rates in bulk carriers if they can carry that petroleum and that crude. But what we've seen over the last couple of years is that these bulk carriers are really really volatile as far as price and that kind of thing. So I would not expect them to be able to keep up that 32% dividend yield in no way, shape, or form. So I would worry about that being cut and what that means for the stock and for investors. This is going to be one of those that it is definitely not a long-term kind of hold kind of stock. It is a stock that you really need to keep up with those dividend rates and those and the sustainability of the stock. What else do we have here? So Vipul wants to know, can you talk about automated investing or ETF mutual fund investing in terms of automated investing? There's a lot of platforms that have like robo advisors, where basically you're just kind of setting up what percentage of your money you want in stocks or bonds, and they're gonna invest automatically, in something each month or each time you put money into your account. And it's a great way to get kind of a low stress, hands off kind of market return. Okay, the best you're going to do is market returns, maybe even slightly below market returns on those, just because you're basically investing in the market, but you're paying the fees as well. Most robo advisors charge a fee anywhere from around 0.5% to 1%. And they're just investing in those broad stock market indexes, those broad index funds, from Vanguard, from Fidelity, and something like that. So you're going to get the market return minus about that 1% or 0.5%, which, if it really depends on what kind of investor you are. If you want to follow the market, if you enjoy following the markets, then that's generally enough to get you that extra, I don't want to say extra return, right? Because there's no guarantee you're going to beat the markets if you follow the markets or follow individual stocks. Most investors don't. Most investors do very poorly when they're trying to pick stocks in that. But I think the extra, that enjoyment of following stocks, that is worth money. Okay, that is worth something. Not necessarily quantitative returns and that kind of thing, but a lot of us here on the channel, myself included, I just love following stocks. I love investing in the markets. I love following these stocks and these companies, and that is worth something to me. Now, if that's not something that you get any kind of a reward or a value out of, then yeah, you put your money in these robo-advisors, you get the market return, or you just invest in the broad stock market indexes, right? That Jack Bogle three fund portfolio where you just have a stock fund, a bond fund, and maybe a real estate fund, right? And you just don't worry about it. Invest your money each month, put your money into those three funds. And with that, you don't even have to pay the the management fee. You just pay the management fee for each fund, but not the management fee for the for the robo advising as a whole. But if you want a no stress investing strategy or something like that, then that's definitely something you want to look into, those robo advisors or just that 3-fund portfolio. We do have a video on the channel about that. I could show you here how to find that, how to find those ETF strategies. If you go to channel. And here, folks, if you ever want to find a video on the channel, you go to videos here, you do this little hourglass, the search, and just type in what you're looking for. So, three fund portfolio. Maybe look at something like that. So, I've got a couple of videos here. This 3 Fidelity index portfolio is all you need. That is going to talk about, that 3 fund portfolio for Fidelity. You can do that. I talk about Vanguard in that as well. And basically that's just going to talk about, just three ETFs, 3 exchange traded funds that cover you on stocks, bonds, and real estate, give you really everything you need in a stock portfolio. If you want a zero stress stock investing strategy, that's what you go through. You go through those three funds, invest your money each month, put a little bit more money in your account each month, put it in those ETFs, and you never have to worry about picking stocks. You never have to worry about beating the market or underperforming the market. You never have to worry about fees or anything. It's just a great way to invest. What was your opinion about the app Starbucks? Tried Jeffrey. Okay, DP wants to know if I'm still investing in Conagra. Conagra Foods, it's one Conagra, ticker CAG. It's one we've invested in on the channel before. I'm not holding shares anymore. I do still like the company. I'm not investing in it yet. There are other consumer staple companies I like better. And again, we've covered those consumer staple companies in the Bowtie Index quite a few times, but I'm not necessarily in Conagra. I think the operating margins have just started to slip for it a little bit over the past year. So I'm a little bit worried about profitability with Conagra versus some of the other consumer staples companies. So again, how I invest, a lot of times it comes down to that market neutral idea or that sector neutral idea. I want to look at each sector, pick the best of breed stocks within that sector. So I make sure I have exposure to each sector in the economy, consumer staples, technology, communication services, whatever that sector is. I want exposure into each sector, but I only want the best of breed stocks within each. Okay, I only want the stocks that are beating the rest of the sector on revenue growth, on operating margin, that are improving their own operating margin over the last year, over the last couple of years, really building on that momentum and that competitive advantage. And that's something I've kind of seen slip on Conagra over the past year or so here. App/dash. What else? So Amit wants to know any opinion on MPW, a business model dividend sustainability. So yeah, MPW is one we've talked about on the channel quite a few times. I do own the shares. Medical Properties Trust, ticker MPW, very strong dividend yield. I think it's a sustainable dividend yield. That is obviously what the market is worried about here. The shares have fallen along with all those other REITs. So if we look at the stock here, over the last year we have seen. Here you can look at over the last year, we have seen that the stock has fallen by about half, almost 50% down to $11 a share. It's now trading, paying a 10% dividend yield. I do think that dividend yield is sustainable. I think it's one of the big things that the investors are looking at and selling the shares off now because of the worry that dividend yield might not be sustainable. But I do like the dividend on this stock, and I love the long-term trend or the theme here in medical properties. Okay, in in those servicers. What Medical Properties Trust does, it buys up, healthcare properties, mostly hospitals, mostly those, clinics, things like that, and then it leases them back to the doctors and to the servicers, right? So it's, obviously we are not spending any less on healthcare than we have been in the past. That is growing at a very strong rate. With aging population, we're going to continue to spend even more on healthcare. So that just makes, this medical properties, healthcare, a very strong trend, over the next 10, 20 years. Now, the problem with these healthcare REITs, and this is something that we've seen not only in Medical Properties Trust, but in really all of these healthcare REITs over the last year, is that the payment reimbursement from Medicare, from a lot of the insurers just has not kept up with inflation. Okay, the insurers, a big part of the payment for healthcare services is through insurance. It's through Medicare, Medicaid, that kind of thing. And those payments, the reimbursement for the services just hasn't kept up with inflation. So a lot of these hospitals, a lot of the service providers in healthcare, they are having trouble, paying the bills. They're seeing their profitability slip, and that is worrying a lot of people. There have been some bankruptcies in medical properties, not Medical Properties Trust, but in healthcare servicers. There have been some bankruptcies in hospitals and in that industry. So people are worried that with these real estate stocks owning healthcare properties, is that, if some of their tenants file bankruptcy, then will they be able to, collect on the rents, on those properties? And so for that, you just have to look at, you look at the portfolios, the properties and the tenants within these healthcare REITs, like Medical Properties Trust, and you see that, as long as any single tenant isn't more than 3 or 5% of their business, then you really don't have to worry too much about those bankruptcies, unless it just becomes a huge, a systemic problem really for healthcare, which I don't think it will. I don't think it comes to that. I think you're just seeing very limited and here and there bankruptcies in that industry. So again, I do own shares of Medical Properties Trust. I own it. I like the dividend here. I think, as we start seeing the healthcare reimbursement from Medicare, Medicaid, from those insurers creep back up and really start reimbursing these healthcare providers, then I think you start seeing a lot more safety and a lot more cash flow here in MPW, and I think you start seeing those shares take off. What else? What else? What about the current AQN situation? Okay, so Mr. Alexis wants to know about AQN. I'm not sure what's happening with AQN. Haven't followed that stock, but I can look into it. Alcoin Power. Yeah. It's a very small power producer. I haven't followed it yet. I can look into that though. What do you think about AMD and Intel? So Sheila wants to know about chip stocks, semiconductor stocks. We've got AMD, so Advanced Micro Devices, as well as Intel. Obviously, I think the chip sector is going through probably a down cycle here this next year. Obviously, we saw over the pandemic, people were just buying up new laptops, new computers, things like that as they were working from home. Saw a huge upcycle in semiconductors. Even to the point of semiconductor shortages. We've now worked through that, and now we're on the other side of the cycle. So I do think AMD, Intel, even Nvidia, a lot of those semiconductor producers, they're seeing the pain there in the lower PC sales, lower gaming. We aren't seeing the gaming trend like we saw in the pandemic. We talked about that before with gaming stocks. So the semiconductor demand, because semiconductors are basically just the brain of a computer, right? That processing power of the computer. So if you're not seeing the gaming demand, if you're not seeing the PC demand, then you're not going to see the semiconductor demand either. So I think over the next year, probably a lot of weakness there continuing in the semiconductor stocks. I do think over the longer term, especially for the U.S. companies. You start to see some of the benefit from the semiconductor bill that was passed. The U.S. government trying to prop up at the semiconductor industry. So I think you start seeing some of the strength from that. But it's still going to be a hard time over the next year. Fabricio wants to know about Medtronic. Medtronic, obviously medical equipment maker, right? I think it's MBD, Medtronic. So MDT. So we can look here at MDT. This is a stock that I haven't covered in the past, but I do like medical equipment. Let's just make sure it's medical devices. So yeah, it's manufacturing medical devices. Physical therapies, right? Pretty well diversified across different medical devices. So one thing you want to understand in these medical devices, medical equipment is all the revenue from maybe one device, right? Or a handful of devices. Medtronic has a very good portfolio of medical equipment and devices. So not really dependent on just one device and that kind of risk. So, I do like in that broader healthcare theme where, healthcare is a long-term trend of spending. I do like the medical equipment devices. I think it is much more stable. So this is when you're thinking about safety stocks that are going to do well as the stock market crashes. I think you can look at a lot of these stocks. Here we have seen some weakness in Medtronic this year, down from 103, down about 30%. So it is underperforming the markets. We would want to look at what's causing that. It is paying a 3.5% dividend yield. We can look at sales estimates for the next year. So we're looking at sales are expected down 3.8% for this year. So if you look at, you can look at Yahoo Finance, look at analysis, and you're going to see the earnings and sales estimates. Here we see current year 2023 sales expected down 3.8% for Medtronic. And earnings down, slightly more, down to $5.27. We do see it's supposed to increase next year, back up to $5.43, sales growth of 3.2%. So sales are expected to increase next year, back into earnings growth. We can see here, what's the stock trading for? Trading for 3.4 times on a price to sales basis. It was up, 3.8, 4.4 during the pandemic as far as price to sales. So a little bit cheaper here, but not necessarily cheap. 3.4 four times price to sales basis. That is still kind of, upwards in growth territory, right? So, still fairly expensive for a stock that is actually, losing sales 3.8% year over year basis, and then only expected to grow revenue by 3.8% or 3 or 4% next year. So still a little expensive, for a stock that isn't growing, isn't really a growth stock. If this got back down to maybe 3 times on a price to sales basis, so then I would be a little bit more excited about the stock, say. So 3 divided by 3.37. So about down another maybe 11%, we'll say. If the stock got down to under $70 a share, so $68 a share, I think I would be a little bit more. I would be a little bit more willing to buy. If it got down to that point, we can see here over the last. So it hasn't gotten down too close to that. It's still 52-week range down to $75. If it got down to about $70 a share, I think I would be closer to buying shares. But I do like the industry. I do like that longer term healthcare trend. I would want to make sure that Medtronic is leading in market share for some of its products, as well as that operating profitability, as well as that sales growth versus its peers, just to make sure it's kind of a best of breed in that idea, in that medical devices segment. But then just on that valuation, again, I would rather see it closer to about $70 a share before I really start getting excited about it. Ethan wants to know about NEO. NEO, I'm not invested in. I am invested in Alibaba. It's the only Chinese stock that I'm investing in right now. Just really worried about, the Chinese government as far as, what it's doing, the regulations and oversight in these stocks. Now, that said, I do like NIO for that, that growth in the EV market for China. We talked about Tesla earlier, how that Shanghai Gigafactory is 40% of the company's total production. So obviously, production and EV growth, EV sales growth is very strong in China. I think anytime you have a domestic company like NIO, NIO is a Chinese company. I think the government is obviously very much going to favor that company in any kind of regulations or restrictions in the EV market there. So, if you are positive on electric vehicle stocks, I think you have to look at China. You have as a market, and I think you have to kind of prefer NIO over Tesla for the Chinese market. We'd have to look at valuations and that kind of thing as well. I think the valuations on both stocks are still very high. NIO. So we can look at NIO right now, almost an $18 billion company, trading for 3 times on a price to sales basis. So that is actually very much lower. All Chinese stocks are going to have kind of a price discount as far as price to sales, price to earnings, when you compare them against U.S. companies, just because of that, that worry over the Chinese government. So if we look at price to sales here, 3 times price to sales on NIO, we can look at Tesla and compare that against Tesla's price to earnings. I think Tesla's price to earnings is closer to about 6 times. So we do see a Tesla price to earnings at 5.7 times on a price to sales basis. Again, the difference there is just that discount in Chinese stocks for valuation. Again, if you think these Chinese stocks are going to remain listed in the U.S. markets, if you think China is going to open up its market, as far as these restrictions off of COVID and that kind of thing, then it's hard not to look at NIO, for that China EV story. Ambrose, see you there, Ambrose. Good to see you. Ambrose, one of the longtime citizens of the Bowtie Nation there, so good to see you there. Curious on your thoughts of. So Peter asks, curious on your thoughts of ABR REIT and G-Cow ETF. Okay, so we have ABR, which is a residential REIT, right? Arbor Realty. Okay, Arbor Realty Trust. Let's look at that. I'm running out of coffee here. Okay. Oh, Arbor Realty is actually a mortgage REIT. So great question. Love that because mortgage REITs. I know mortgage REITs are very popular here. So we're going to look at that. So Arbor Realty Trust, ticker ABR, now paying a 11.7% dividend yield. It is a mortgage trust. So I really need you, if you're attracted to these dividend yields, right, of 11 and 12%, I really need you to look in the companies and understand their business models. Understand, how the larger economy plays on these business models, things like that. In these high dividend yield stocks, you get a lot of mortgage REITs like Arbor Realty Trust that we'll talk about. You get a lot of BDCs, those business development corporations. And so you really need to know how interest rates affect those companies and, the outlook for those. So for mortgage REITs, obviously, these companies, they are borrowing on short-term rates. So very short, the 3-month rates, that kind of thing, very much 0 rates still. They've crept up this year, though, and then they're lending out, or they're investing in those mortgages, those longer-term mortgages, right? And they're leveraging that money, right? So they might borrow, they might only borrow, 200 million on the short-term rates, and then leverage that money up 3 or 4 or 5 times to buy more mortgages. So with the sell-off or with the drop in the mortgage market, because those interest rates have gone up so fast, we are really starting to see pain and weakness in the mortgage market. Okay, a lot of home buyers can't buy homes because the mortgage rates are so high. A lot of people locked into their mortgages, because what are you going to do? What are you going to sell your house with a 3% mortgage? You're going to have to turn around and buy another one with a 6 or a 7% yield interest rate on your mortgage. So we're starting to see a lot of weakness, a lot of pain in the mortgage market, and that is flowing through to these mortgage REITs. I don't see, real estate and housing is something that generally lags the rest of the market. as far as or the rest of the economy. I do not see the housing market rebounding this year. I think it's only going to get worse. So I really, I think these mortgage REITs are in for more pain. I think it gets worse before it gets any better for these mortgage REITs. They are still strong companies. We're still always going to need companies to buy those mortgages and invest in those mortgages. So we're always going to have mortgage REITs. But there is still, I think, more pain to come for these mortgage REITs like AG&C, like Arbor Realty Trust, like Two Harbors, those companies. You can invest in them, but you have to be ready to see some losses on the price, and you have to be ready to hold those for at least the next 2 or 3 years. Once we start seeing the Federal Reserve lower interest rates, once we start seeing them stop raising interest rates and then start lowering interest rates, I think these mortgage REITs are going to do a lot better. Just because, on their portfolio of mortgages, as rates come down, those portfolios get more valuable, and the stock price goes up, right? The net asset value of those mortgages goes up, as interest rates go down. So I think that's something you have to understand with mortgage REITs. You have to be watching for with mortgage REITs, and you have to be willing, if you're investing in these just for that dividend yield, you have to be willing to hold on to those stocks, take a little bit more pain, as the price comes down, and hold them for the next 2 or 3 years while you wait for those interest rates to start coming down again. Okay, so yeah, DP asks, you wouldn't touch Tesla yet. Yeah, I probably wouldn't. Again, we talked about Tesla earlier. I would not buy it just yet here. It's just under 6 times on a price to sales. It is coming down to very attractive valuations. We've talked in the past about how I would like to see Tesla at right around 5-6 times on a price to sales basis. That would be attractive valuation territory for the shares. But I do want to see what production numbers are. I want to make sure that it's not losing too much reputational value, that it is going to be missing its production targets here in the next quarter. Okay. So I really do want to see, I want to see this next quarter's production targets or production numbers to make sure that it's not falling back. Tesla has been doing a lot of discounting and a lot of end of year programs or sales to really boost that fourth quarter production or fourth quarter demand, fourth quarter sales, right? And that kind of worries me. Why are they putting out so many incentives to get people to go to their Tesla dealer and buy a car, so much more than they have in the past? Are they really seeing or demand for Tesla fall that much? What else was in the best? Thoughts on Zoom. Just in time wants to know about thoughts on Zoom. Zoom, obviously one of those pandemic darlings, did very well. As everyone was Zooming, was online Zoom video communications, ticker ZM. This is one that's been hit. Now the problem with Zoom is there are just so many other alternatives, right? That it is down. So we see here down from about $480 a share down to 65. Let's look at the sales growth and the price to sales on Zoom. So this year expected to grow sales by 6.7%, next year by 5.4%. So sales growth, definitely not a growth stock anymore. 5-6% sales growth. It is expected to fall. Earnings per share is expected to fall this year as well as next. So no hope from analyst expectations there. Let's see on a price to sales basis what it is. So it's still trading for 4.6 times on a price to sales basis. Obviously very much lower than what it was in the past. Here 2021, 2022 traded for 22 times, 12 times price to sales in that pandemic peak. But even as recently as last quarter traded for 6 times, just this year 7.5 times price to sales. So it is coming down, but 4.6 times price to sales is still growth stock territory, right? This is still trading as a growth stock, and we just don't see that growth anymore, right? We see 5-6% sales growth on a year-over-year basis, and the problem is does it come back into that growth stock territory? How do they increase their sales growth back into that 10 or 20% annual growth measure? And I just don't know that I see it. There are so many other alternatives, so many kind of better alternatives for video streaming, for video conferencing, right? You've got Microsoft, you've got Facebook, you've got some very big players in that competing against Zoom video communications, and I just don't know that Zoom is kind of a best of breeds kind of idea. So what else? So do you think Reddit will ever become? So Troy wants to know: do you think Reddit will ever become a stock we can buy? Yeah, I think there is an IPO in the future for Reddit. I think it probably would have happened this year, or maybe or late last year if the market hadn't come down for those growth stocks. I think they were looking at something like that. But I do think once the economy rebounds, I do think you see Reddit as a stock. As a publicly traded stock. So I'd be watching for that, whether it goes through an SPAC, a special purpose acquisition company, or whether it just does an IPO on its own. But I would be watching for that, and we'll be watching for that when it does come up. What else? Okay, everyone talk about Epic Games as far as a publicly traded stock. I do think that comes forward. This is something we covered a couple months ago. Epic Games as a private company that you can invest in, through Disruptor. You can actually pick up shares of Epic Games through that, and I do think eventually, very soon, a couple of years, that has its IPO as well. Epic Games, much more than just Fortnite. It's also got a reality engine software that is being used by movie producers, by concert event producers. That is really some really amazing virtual reality, augmented reality kind of ideas. So yeah, I do think Epic Games comes to market probably within the next 2 or 3 years at the most. A lot of these IPOs, obviously, just waiting for the market to improve, just waiting for more investor interest in IPOs and new companies. What else do we have here? Looking through obliterate Unity. So yeah, Unity Software, the other kind of augmented reality VR kind of company there, competing with Epic Games. I do like Epic Games a little bit better there, just for their Unreal Engine, I guess it's called. Does very well as far as they're working with. So Epic Games is working with Disney. I know they're working with Marvel for a lot of their VR kind of augmented reality special effects and that kind of thing. Okay, Fiverr and Upwork. Frank wants to know, what are your thoughts on Fiverr and Upwork? Could these be good recession plays as people lose their jobs, businesses look to leverage freelancing? Love the thinking there. What do you think is best in class as far as Fiverr and Upwork? So let's look at these because I think it's not only can we look at that idea of, okay, so as companies lay off workers, will they be looking more towards freelancing? What we actually see here is that, as companies start laying off people, then they lay off the freelancers first. Okay, so I haven't looked at Fiverr or Upwork, as a stock, but I would expect their revenue is probably taking a hit on, as we start seeing the employment numbers get a little bit worse, because again, as companies start to see a recession coming, as they start to slow down on hiring and then eventually start laying off workers, then they're going to lay off the freelancers. They're going to lay off the part-time workers and the contractors first, trying to keep on their full-time workers as long as possible. Okay, so at first, anyway, you do start seeing these freelancer sites, like Upwork, like Fiverr, and the freelancers themselves kind of take a hit on that jobs picture. But then, obviously that's going to reverse when the economy starts rebounding. First, companies tend to bring on more part-time help, more contract, more freelancer help, just to make sure that the economy is growing. They don't want to, if they've got more demand for their products, they need to ramp up production. They don't want to bring on a whole bunch of full-time workers until they are sure that the economy is rebounding and they're going to have that demand stay around. So they'll pick up more freelancers, more contractors, more part-time workers first. So as we see the jobs market weaken, as we start seeing more layoffs, more things like that, then yeah, I think you're going to see weakness first in these freelancer sites like Fiverr, like Upwork. But then on the other hand, as we get later into 2023, later in the year into 2024, as the economy starts rebounding, I think that's a good opportunity to look at these stocks. Now, what I think you can do, what I want to do in comparing these stocks. So that's maybe the longer term picture, the longer term idea. Now, what you want to do with that idea, when you're comparing stocks, finding those best of breed stocks, is you want to compare them against each other to see which ones are maybe a little bit stronger competitors or stronger on that idea. So what we can see here for Fiverr, we can go down here to revenue. Revenue growth, quarterly revenue growth of about 11%. We can look here to analysis. So we can see that, okay, so analysts expect revenue growth at Fiverr of 13.5% this year, 9% next year, so slowing down a little bit, but still about 10% revenue growth for Fiverr. Okay, and then we can look at, so those main two topics or main two metrics that I want to look at for a company within its industry to really find the best of breed ones is the revenue growth and the operating margin. Here we see operating margin of negative 19% for Fiverr, so it is not quite profitable yet. Negative operating margin, 19% there. And now what we want to do, we want to look at Upwork. Ticker UPWK. So Fiverr there was FVRR, Upwork UPWK. So here we can look at revenue growth for Upwork, revenue growth of 22% this year, expected 18% next year. So very strong revenue growth there for Upwork this year and next. It is still an unprofitable. It is still expected to lose 12 cents a share this year, but expected to return to profitability next year, 3 cents a share next year. We can go to statistics here, look at price to sales, trading for 2.3 times price to sales, operating margin negative 15%. So better. So what we're seeing here, when we compare Fiverr and Upwork, okay, what am I seeing? I'm seeing very much stronger revenue growth at Upwork. Okay, I'm seeing revenue growth of 20% year over year revenue growth this year and next for Upwork versus just 10% for Fiverr. I'm seeing an operating margin that's better at Upwork. Okay, negative 15% is better than negative 18%, and and next year it improves even better to a positive operating margin. So the profitability at Upwork is stronger. I'm also seeing, so we didn't look at valuation here, but 2.3 times on a price to sales for Upwork. Let's go back to Fiverr, FVRR, and see what the valuation there is. We can go to statistics, and we can see it's trading for 3.3 times. So, I mean, this is never an exact science. You can never be completely sure which stock is better than the other, but just on this, if you're just looking at that revenue growth, valuation and price to sales, operating margin, I like Upwork very much better. Okay. And, being a user of both sites, just that that research and anecdotal evidence, I very much prefer Upwork to Fiverr. Okay, Fiverr, you never really know what you're going to get on these, on the jobs that you post or the hiring you do on Fiverr. A lot of it is very much, shoddy workmanship. I want to say, and you get what you pay for. A lot of these Fiverr deals, $5, $10, $15 each. You're going to get what you pay for. And my experience on the platform hasn't been that positive. Upwork, I use Upwork for my editor, for a research assistant. I use Upwork for other, assistants, other general assistants, VAs, and that kind of thing, virtual assistants, things like that. And it's it's fairly expensive. I think they charge maybe a 10% fee on what you pay the assistants or what you pay the freelancers that you hire on Upwork. But I still use it, right? Because it is so much easier to find and source talent, to continue working with talent and pay through that. So I still use it. I still pay those, that fairly high charge just for working with those freelancers. So, on that, qualitative research, I guess, and anecdotal evidence, I do prefer Upwork better than Fiverr. We saw there in the metrics that I follow the 20%, so much stronger revenue growth at Upwork versus Fiverr, much stronger operating margin, so profitability, and much stronger, better valuation, 2.7 times price to sales versus 3.3 times price to sales for Fiverr. So I like Upwork better here on all three of those. Now, you would still want to compare it maybe against some of the other freelancer sites. Don't know which ones are also traded. Those might be the only two tradable stocks in that space, but Upwork does seem to be a best of breed in that space for that. But again, looking at something like this, I would worry about the near-term sales for a company like Upwork, just on that idea that, as companies start to lay off staff, as the jobs market's a little bit weaker, they're going to lay off those freelancers. They're going to lay off those contract workers first before their full-time workers. So sales growth probably going to be slowing down a little bit for Upwork, but then will rebound, once we head into the next economic cycle. I keep on reaching for my coffee, and there is nothing in there. So got to go back to water. What else? Good stock in lithium. Edlin wants to know a good stock in lithium. I really haven't covered lithium in so long that it's hard to know which one. I do know. Wasn't there Albemarle Resources, ALB? Albemarle Corporation. They're over in Chad's neck of the woods. I think that's lithium, right? And that is that's lithium. So ALB. If you're looking at lithium, I think you can look at ALB. It is down this year, obviously, with the sell-off in electric vehicles. The fears are around electric vehicles, but actually doing very well. It's only down maybe 5% or so this year. So not down very much, 5, 6, 7% down this year. So holding up fairly well. So definitely look at ALB, Albemarle Corporation. And I know Chad always rags me about pronouncing that, but that's how it is. Can you view LNC most recent quarter, most specifically comprehensive income that was up so much? So Mando wants to know about LNC, so Lincoln National Corporation, just been slammed. Have noticed that the stock has been slammed over the past year. We can look at that. I have not covered the stock, so I'm not quite sure why it's down so hard over the past year, and really around its earnings as well. That's one thing that really worries me about insurance companies. Any insurance company that falls so hard around its earnings releases. Why is management missing those earnings estimates so badly? You don't normally see investors invest in insurance companies because of that cash flow stability, because of that stability in the business, and to see it fall so hard, during those earnings reports means that management is just screwing this company up so badly because it doesn't have that kind of stability or cash flow safety anymore. So I would definitely worry about Lincoln National. I know a lot of people are probably looking at the 6% dividend yield. It's the price to book value is probably very, very low on this. Actually, it's very high, 2.3 times price to book. So this is not the value stock you think it might be. Okay, so I would definitely worry about valuation and what management is doing that is missing expectations so badly on that stock. So I'll have to look into that a little bit more to be able to answer your question to see why they're really missing quite so much on that. Okay, so yeah, Chad says ALB is 45 minutes away in the city of Albemarle and Charlotte. What do you think about silver? What else? I'm actually still up significantly on picking. Yeah, I mean, if you look at, so one thing I've been watching is some of these commodity plays. And so all you out there in the nation know, we've talked about copper, we've talked about, lithium, some of these commodity plays. We have just not been developing those resources enough to cover expected demand over the next couple of years. We're looking at a copper shortage, a global copper shortage by 2025, right? So production falling well under what we need to meet those demands. That's why I like FCX, Freeport McMoran. That's why I like Southern Copper, SCCO. We're in the same situation for lithium, for a lot of these other renewable energy metals, okay? Especially for copper, anything that's going to carry an electric charge through it is going to need copper because it's such a good conductor of electricity. So, as we not only electric vehicles, but as we build out the infrastructure for alternative energy and, and renewable energy products, things like that, tech and gadgets and things like that, we're going to need a lot more copper, right? And we have just not kept up with the copper production, with the copper mining. So, for copper, I would look at those individual companies like the FCX, like SCCO, look at copper miner ETFs. There's a copper miner ETF that you can invest in, as well as, some of the lithium and some of the other metals as well. Okay, an income ETF, a decent price to add. Tom wants to know an income ETF at a decent price to add, like RYLD, JEPI, both to maintain value and open a good price per share. Okay, so we talked about that quite a bit earlier in the live stream. I'd go back and watch through that. I do like the JEPI better. That's the JP Morgan Equity Premium ETF, that ticker JEPI. A lot better than some of these other, the QYLD, the RYLD, XYLD. If you just look at a price chart of those covered call ETFs over the last 2 years, the JEPI has actually held up pretty well. Over the last 2 years, I think the JEPI is down less than 1%, whereas the rest of those, the RYLD, the QYLD, the NUSI, all down 20, 30% over the last couple of years. So if you're looking for price protection a little bit, as well as those high dividend yields, I know the JEPI is still paying about a 10% dividend yield. So I would definitely look at the JEPI rather than some of those other income funds. Jackie wants to know about blue chip defense stocks like LMT. Talked about LMT, talked about Northrop Grumman earlier as well. I would also look at Raytheon Technologies, I believe RTX. We talked about why those are up. Obviously, the war in Ukraine really boosting defense stocks as the U.S. Gives more weapons, sends more weapons to Ukraine. I would be worried about valuation on some of those. They are trading quite a bit higher. I think we looked at LMT, so Lockheed Martin, that was trading at right around 2.2 times on a price to sales, something like that. Whereas in the past, it's traded closer to about 1.5 times on price to sales basis. So we are starting to see a little bit higher, more expensive stocks in that defense segment. I would, kind of wait for a pullback on some of those. I think those defense stocks have gotten a big boost here since October, when the U.S. started talking about the defense spending within the annual budget, the government budget. Got a big boost from that because obviously that defense spending was going to be much higher. So yeah, you really have to, I think you wait for a pullback in some of those defense stocks. Okay, CIM Chimera is going to be another mortgage REIT. Just talked about the mortgage REITs. I do think we still see some pain, some weakness in mortgage REITs here, at least for the next year. I think, again, with mortgage REITs, with anything housing related, real estate related, that is going to trail the broader economy, right? And especially the housing stocks, the housing related stocks. That's going to trail the rest of the economy. So I would wait to see a little bit more pickup in the rest of the economy before we really see any kind of a rebound in the mortgage REITs. I do think, if the Fed does lower interest rates, which we're not expecting that to happen until at least 2024 at the earliest, then that's when you start seeing those mortgage REITs rebound, like Chimera, CIM, like the ones we talked about earlier, AG&C, those mortgage REITs. They really have to see mortgage rates. Those mortgage REITs really have to see the mortgage rates drop before those stocks can rebound. Okay. So Paul wants to know about TTCF. And I probably wouldn't answer this question for anybody but Paul, or anybody but one of the longtime citizens of the Bowtie Nation, because I just, have not liked this stock. I have not liked how it's been hyped up by a lot of other YouTubers, really kind of chasing Tattooed Chef, by a lot of other YouTubers. It's been nothing but problems. Down from $15 a share here, just beginning of this year, and I know it's down from, really when you saw the other YouTubers pumping it at $28, $30 a share, that kind of thing. It's one that I haven't covered. I hate to give you just a back of the envelope kind of idea. Packaged foods, it's in the consumer defensive stocks, so it's really disappointing because you would expect consumer defensive, consumer staples to do well. Plant-based food companies, okay, so there we are. The market has really dropped out for any kind of plant-based food. We've seen it in Tattooed Chef. We saw it in Beyond Meat. Now, so at this point we can go. Let's look at what the analysts think it's going to do as far as revenue. We're supposed to do revenue of 9.6%, revenue growth 9.6% this year, 5% next year. So analysts really don't expect the revenue growth to increase here. There's only 5% next year, so that is not a growth stock. Expected to post $1.37 in per share losses this year, down to $1 per share losses next year. So, it looks like they are trying to cut expenses. So it's only going to be $1 per share loss next year, but that is still a loss. So anytime you've got a company with that big of losses per share, $1 per share losses expected next year, you really got to start thinking about viability and what their balance sheet looks like. So you go here to the financial statement, you go to the balance sheet, and you want to look at cash on hand. You want to look at, so you look here in total assets, expand this, current assets. So they have cash of, here we are. Okay, 92 million in cash. Okay, so that's fairly good. If we look at, then you're going to want to look at liabilities. And we'll look at long-term liabilities, 7.3 million in long-term debt. Okay, so that is a very good balance sheet, right? You've got, if you look at the balance sheet here on Tattooed Chef, you got $92 million in cash, little over 7 million in long-term debt. Okay, so they are net cash positive by, what is that, 85 million? Yep, $85 million in net cash. Now you go to cash flow. Okay, so how much cash are they burning through every year? That's the problem, really. Okay, when you've got losses per share, when you've got negative operating cash flow right here, right? And it's we're in annual here, so it's getting worse. They're actually losing more money on their operating cash flow every year. They're only covering it by borrowing more debt, but they're still 92, 130. So they lost $40 million from 2020 to 2021, $40 million net change in cash, about $80 million net change in cash here from last year to the trailing 12 months. So the problem, I'm sorry, didn't even realize I wasn't showing you this. Okay, so what we're looking at here, looking at Tattooed Chef, ticker TTCF. This is really how I analyze, how I look at some of these stocks, right? You look at analysis, you look at sales growth, okay? So like we said, expected 10% sales growth this year, slowing to 5% sales growth the next year. So very slow sales growth especially for a growth company, something that's supposed to be a growth stock. Gonna lose $1 per share next year in earnings. So still going to be very much a negative earnings company. So for that, you really want to start with the balance sheet, like we talked about here. Go to the balance sheet. You go to total assets, current assets, and you look at how much cash they have. Okay, so we do see it has $92 million in cash on the balance sheet. Okay, so that's a good sign. It's got a lot of cash. Then we look at the total liabilities, non-current liabilities, so long-term debt of $7.3 million. Okay, so that's where we got that idea that they've got $85 million in net cash. They could pay off all their debt, still have $85 million in cash. Now, the problem is, how fast are they burning through that cash? We already saw that they're expected to lose $1 per share still next year. And if we look here at the cash flow statement, we see an idea of, how much cash they're losing every single year. Here from 2020 to 2021, they lost $40 million in cash, or the operators, they had to have $40 million in cash to cover all those losses, right? Here over the last year, from 2021 through 2022 here, it was like 80 million, just under 80 million. So they burned through $80 million in cash just in that year. So, while I'm hopeful that $85 million in net cash, gives them the time to grow their sales and to grow that, they're burning through it so fast that they are going to have to increase debt. So they're going to have to take on more debt, which right now, this, with the shape the company is in right now, that debt is going to be extremely expensive. It is going to be very high interest rates to take on that debt. So they're probably going to have to just issue more shares. We're going to see here in Tattooed Chef, just like what we've seen over the last couple of weeks in AMC. They're going to have to dilute their shareholders, issue a lot more shares, just to raise cash, right? And of course, with the shares down so much, they're not going to get much from those shares. So that's really what the market is looking at. Why shares are only trading for $1.12 per share, or why this company is only trading for $1.12 per share, 93 million market cap, because investors are worried that this is going to be a company for that much longer. They're worried that this company is going to be out of business because they are burning through upwards of $80 million in cash each year, and and they've only got so much cash on the balance sheet to cover that. So they are either going to have to raise a lot of cash through stock sales, or eventually just be bankrupt. So you've really got to believe in the turnaround story here, that they can get that sales growth higher, that they can get that earnings per share back into positive territory. And I haven't covered that stock very much. I haven't wanted to recommend that stock like a lot of other YouTubers I know have been recommending it. So I can't tell you as far as the earnings outlook or the sales outlook and whether it can become once again a growth stock. But I wouldn't be able to take that kind of risk. Okay, reaching for the coffee. It's not there. What else we got? Paul is thinking $3 a share for Tattooed Chef by next year. Again, it has to have some kind of very good news, to drive it up to there. Something very good as far as sales growth and eating into that cash flow, that cash burn, because it is just burning through so much cash right now that it's got those existential worries about the company. Let's trade back from that into some of the other growth stocks that I am actually positive on. So Ethan wants to know about SoFi, Jackie asking about TDOC. So again, just kind of like that Tattooed Chef, although I think the Tattooed Chef was more kind of a meme stock, right? Really boosted by the internet and YouTubers and that kind of thing. Not quite the business model I think that SoFi or TDOC had, but nevertheless, those are down quite a bit as well. Those growth stocks. So we do want to talk about those. We've talked about those quite a bit on the channel. I do invest both in SoFi, ticker SOFI, as well as Teladoc Health, ticker TDOC. I think those are both very much leaders, best of breeds in their industry, and have very strong futures. So SoFi Technologies, you've heard me talk about it. It is, I think, probably the best online bank, fintech bank out there. It does, unlike a lot of these other fintech stocks, a lot of these other online bank stocks, then it does have a banking charter. It bought, I think, a Pacific West Bancorp or something like that a couple of years ago. I gave it that banking charter, so it's able to offer, all different kinds of accounts, savings accounts, checkings accounts. It has access to those lower rates that are available to only chartered banks. A lot of those other companies don't have that. Those online banks, those fintech companies don't have that advantage. So I think SoFi is really using that to its advantage that having that bank charter. We do see, obviously, we've seen a lot of weakness in SoFi just around the student loan moratorium. People haven't had to pay back their student loans in more than a year. It continues to amaze me how long the government is putting off this student loan repayment. Jobs pictures, unemployment is at the lowest it's been in decades. I do not know why we don't have to pay back our student loans. And this has nothing to do with, forgiving student loans, anything like that, but just, making payments on student loans. So I don't know. I think it is kind of political. That student loan moratorium. The economy has been great for the last couple of years. We just started to see the weakness this year in the economy. So I don't know why that student loan moratorium was pushed off. But I don't want to get political here. But SoFi has been weakened because of that. It started out as a student loan services company, so it still has a good chunk of its revenue in that student loan segment. So obviously, if student loans aren't being repaid, then that is a weakness. That is a headwind for SoFi. As we start seeing the student loans, that moratorium come off probably next year, and I say that, but every time that it gets extended beyond reason. But if we do see that student loan moratorium come off next year, which it should, then I think you see a big bounce in shares of SoFi. I think the longer term picture for that stock is much better though. So I'm holding on to that stock. I still like that stock. I mean, we can look at the measures real quick here. So here you see SoFi Technologies trading for $4.50 a share. That's right around the 52-week low. So that is well off of the highs from last year. We can see that analysts expect 51% sales growth this year, 33% sales growth next year. So slowing down a little bit, but still 30% plus sales growth, revenue growth at this company, even with that weakness in the student loan segment. It is expected to reduce its earnings loss to 26 cents a share next year. I believe probably even profitable by 2024. So we will see per share profits for SoFi within the next couple of years. But here, this is really what I'm looking for. These are these growth stocks that everybody loved over the last couple of years. I wasn't invested. I couldn't recommend SoFi or Teladoc over the last couple of years just because of that valuation. They were just so expensive. But just this year, I started buying SoFi, I started buying Teladoc, because if you look at these companies, they are still growing at 20, 30% plus a year on their revenue. They are still growth stocks. They're still dominating their industry. And that growth theme, investors have just given up on the stocks because of the broader stock market picture. But if you look at this, 30% sales growth, and we've seen throughout the live stream, we've seen all these other growth stocks. Zoom growing at just 5% per year sales growth now. We've seen Tesla growing. Tesla's actually doing pretty well. I think Tesla's still up about 50% sales growth. But all of these other growth stocks slowing down so much to single digit growth. And here we see SoFi is still growing at 50%, 30% next year. Price to sales of 3 times on a price to sales basis. So very much down from 14, 15 times price to sales, even 5 times earlier this year. So 3 times on a price to sales basis for SoFi, still growing, still dominating that growth theme. So that's kind of my outlook on SoFi. Now I want to look at Teladoc here, kind of the same situation, a stock that I just couldn't recommend over the last couple of years because of that expensive valuation, but started buying it this year on the sell-off. And again, this is a company, it is still growing 18% this year, 13% next year expected sales growth. So it has slowed down from that 20% plus sales growth per year, but it is still growing double digits per year in sales growth. And I believe they do better. I believe they beat and post at least 15% sales growth next year, maybe even back up into about 20% sales growth next year. You look at statistics. This is a growth, a stock trading at 1.6 times on a price to sales basis. So a growth stock trading in really for right around that value stock basis, value stock multiples, down from 7 times, from 10 times price to sales back in 2020 to 2021, back even 5 times price to sales here in earlier this year. And so if you look at these companies, that are still growth companies, okay, still growing their sales by, double digits, 10, 15, 18%, for this year for Teladoc, 50%, 33% next year for SoFi. These are still growth companies. Teladoc is still dominating the market for virtual healthcare. Okay, and obviously virtual healthcare has come off of its growth, during the pandemic. Obviously, we had no choice. Everything was virtual then. It's slowed down now. But is there any doubt that we're heading towards a more virtual experience, more virtual, virtual industry for healthcare, right? It lowers the costs immeasurably in healthcare. Healthcare costs are one of the fastest growing costs we have to pay. To be able to do that virtually is so much more convenient and so much cheaper that you really want to go with that kind of a growth theme. Okay, and again, Teladoc is dominating that growth theme. That's why I continue to buy the shares. Even as the shares drop this year. So again, it's something that you gotta wait for this company to grow into that thesis. You gotta wait for the market to come back to growth stocks. Right now, nobody loves growth stocks. Obviously, we saw those price to sales valuations. People were paying 7 and 10 times price to sales, and even higher for shares of SoFi. Just last couple of years ago. And now they're only willing to pay 3 times or 1.5 times or 1.6 times price to sales. People have just given up on these growth stocks. Well, if you're a long-term investor, what does that mean? You buy when there's blood in the streets, right? Buy when everyone else is selling. And I truly believe if you can find those stocks that are still growth stocks, that are still growing at double digits, double-digit growth rates, and dominating their industry, those are the stocks that are going to be worth it. What else? We got ZS. Somebody wants to know about Crowd's Zscaler, and another one was Crowd. We've covered these on the channel before. These cyber security stocks. I do like ticker ZS. The problem is these are still so expensive. These are still growth stocks, in a growth industry. So that's great. The cybersecurity industry is still growing. It's still one of the few growth industries that investors are paying for. And these are 2 dominant leaders in the space. I like Zscaler a little bit better, ticker ZS, excuse me. I like it a little bit better for its kind of unique and innovative approach to it in that cloud cybersecurity space. But the price to sales is still very high on these. We can look at Zscaler here, ZS, to show you the price to sales on this. Now these have come down quite a bit. I actually recommended Zscaler here in 2019. We were in shares of Zscaler right around $84, $85 a share here. Mid 2019 is when I first started talking about it. It went up all the way to over almost $350 a share there in 2021. And then has since just crashed along with the rest of the growth stocks, now down to about $108 a share. But the problem here, and if you look here in the analysis, we are still expecting very strong sales growth. 40% this year, sales growth of maybe 30% next year. So still very strong sales growth. These are strong, growth stocks in a growth industry. But the price to sales is just still so expensive on these. 12 times price to sales, 19, 20 times earlier this year, upwards of 46 times, 64 times last year. So, all you out there in the nation, one of my rules is I just cannot pay more than 10 times price to sales for a valuation, even for a growth stock. We saw shares of SoFi growing revenue at 50 and 30%. So very similar to shares of Zscaler there, and yet trading for only about 3 times on a price to sales basis. Here we have that same growth, that same 30% sales growth expected next year, but trading for 12 times. So 4 times more expensive on a per share basis. It just gets very hard to pay that much for a stock. It saved me from a lot of the losses over the last couple of years, over the last year on those growth stocks. Again, we were looking at growth stocks last year and just could not invest in them, even as those shares started coming down. Still very much too expensive, over that 10 times on the price to sales basis. And, I still see that in Zscaler. I still see that in a lot of these cybersecurity stocks. Very good growth, but still very expensive. So, again, I would like to see, I would just like to see Zscaler. I would like to see some of these cybersecurity stocks come down a little further before I really start getting excited about the valuations on those. Okay. We are heading into 2.5 hours here, so I'm gonna cut this one off. Tried going for 3 hours, but just can't make it this time. Appreciate everybody being here. Love connecting with all you out there in the Bowtie Nation. Thank you again. And we're gonna try doing more of these live streams every Monday for your Monday market update, 9 a.m. Eastern. So